Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello dear friends, today we are going to do the revision of this chapter called International Financial Management. Now this is a very interesting and twisted chapter like most of the chapters in AFM. But one of the things with this chapter, the chapter is actually fairly simple and in real life it is actually very interesting. But from an exam perspective, there are only 2 or 3 types of questions that can be asked. Okay, and out of that, couple of them are very simple, but there is one variety of question which is actually a time waste. So that particular variety of question, if you are asked, it will suck away half an hour, 45 minutes of your time, and it is basically a delaying tactic for your completion of your exam. So as far as IFM is concerned, if you get simple questions on GDR, if you get a question probably on MIRR, it is fine, or adjusted present value, it is fine. But if you get any question that basically has foreign investment, domestic investment in currency, inflation rate, and then then you have to evaluate the investment, then there are withholding taxes are adjusted, then taxes are paid next year. If moment you get complications like this, I would strongly advise students not to attempt that particular problem in the exam. Okay, there are 2 or 3 kinds of problems. I specifically say don't attempt in the exam. This is one variety. A lot of people mistake when I say IFM, don't attempt IFM question. I am referring to this kind of question in IFM. Right, this very specific kind of question which has too many variations, too much of computation, too much of arithmetic, and the answer can go anywhere. So those are the kind of questions. I will solve those questions in the our revision session. But my strong suggestion is, if that kind of a question comes in exam, from an exam perspective, unless you see it is very simple, it does not have too many adjustments. If moment you see it has 4 or 5 adjustments which are complicated, just ignore. Because you will lose more trying to solve that question than you will gain by actually solving that question in the exam. This happened in November 24 also, where they asked a question which was very poorly framed, very confusing, very twisted, right? And they missed certain key terms, and students were left going round and round, goal and goal. Okay, so I will take you through everything, I will help you explain everything, but if a twisted variety of problem comes in the exam, don't solve it, rather go for other questions where you get better opportunity, chance and possibility to score marks. Okay, so let us first start off with this chapter, International Financial Management. As I said, it's a very interesting chapter, a lot of new things that you will learn. And those of you who don't know about me, I am co-founder CEO of IndigoLearn. I teach CA final students for AFM. I also teach CFA level 1 and level 2 students. I've taught 4,000 plus students over the last few years. I'm very, very interested in economics and financial markets. That's my, you can check out my LinkedIn profile or tweets or, what I do. Most of the stuff that I talk about generally is, financial markets or economics or, the overall macroeconomy and all of that. Those are my areas of interest in life. Okay, now enough stuff about me. Let us move to this particular chapter. Now, as I've been doing in most of the other chapters for, this last day revision kind of a session, whether you're watching it on YouTube where sometimes we would have given it free, or whether you're watching it on our, website or app where we are actually, selling a separate course or created a separate course called AFM Fast Track Revision. Either ways, you will have access to this PDF. So if you do have access to this PDF, you can keep it open, and as I am talking, you can probably make notes or whatever. Second thing, please note, if you are watching this on YouTube, please do like our channel, please do subscribe to our channel, please like this video, please share this video, please let your friends know that there is a playlist of key important chapters revision that is available on our YouTube channel, and of course revision lectures are also available on our website. I know beginning itself I'm saying this, but I just want to put it out there so that the communication gets through very clearly. Now let's dive right into the chapter. What is international financial management? Now this chapter talks largely of as I said, there are questions on GDR, very simple, very plain topic. Then there may be a question on MIRR. There may be a question on adjusted present value. Then largely there are questions on evaluating international projects. These are 4 types of questions, but these are problem oriented. And if you actually look at the new syllabus of AFM, you will see that Forex plus interest rate risk plus IFM together constitute 20 to 25 marks. Okay. And there are cases where it was 16 also, there are cases where it is 32 also, marks distribution, even though the skill wise weightage says 20-25. And this questions from this particular chapter are not consistent. From Forex and interest rate chapter, the questions are very consistent, but from this chapter, it is not 100% consistent whether in SFM old syllabus or AFM new syllabus. Okay, sometimes it is there, sometimes it is not there, which is why I don't put it as the most important chapter. I have 5 important chapters: Forex, derivatives, portfolio management, advanced capital budgeting, and interest rate risk, which is why this chapter is not part of that famous 5 list. Okay, so now coming directly right into this particular chapter. What are complexities in international capital budgeting? So when you're referring to international capital budgeting, you're basically saying one company based out of, let's say, in India or let's say in US. If let's say you are an Indian citizen, you are calling yourself as home country, and you are, let's say, you are investing, you are an Indian citizen investing in US. In US is called as the host country. So you have to know this distinction. Where you are based out of is known as home. Where you are making an investment is called as host country, right? Who's hosting you? Now, when you make such kind of project related investments, it depends on different kinds of scenarios, what is being asked in the question in the exam and in real life also. Are you going to evaluate project cash flows, or are you going to evaluate the cash flows that come back to the parent or the home country? Okay, that's a very important topic, we'll discuss that. But in that process, what are the various other issues that you face? So you can actually look at this. What are the other issues that you face when you make an investment from one jurisdiction, one geographical entity, a country to another country, right? So you have cash flow conversion to parent currency. So that's what exactly I told you. You make an investment in US, when the money comes back to India, you have to make conversion into Indian rupees. So cash flow, let's say, comes every year. Then you have to project every year's USD INR exchange rate, or cash flow comes only at the end. Then you have to make a projection like that. Initially, when you make an investment, there is a USD INR exchange ratio component. So you have to be very, very careful with respect to cash flows and the exchange rate for that. Then parent versus project cash flows. As I said, parent cash flow, that is what is coming back to the Indian company, versus project, which is what you made an investment in US, both are different. Why? Because there are some taxes, because there are some exchange issues, and there are other related issues. We will see them as we move forward, but those are also important. Then project profits remittance subject to double taxation. Yes. So when you make remittance of whatever investment you have made in the US, when the money comes to India, there could be scope for double taxation. That is, it's taxed in India also, in US also, then it is taxed in India also. Or you may have a withholding tax when you make remittance to India from US, or you may have ulta also from US companies making investment in India. So when they have to take money out of India, Indian corporate tax may be applicable. That corporate tax they may have a double taxation treaty, may not be there, may be there. There may be a withholding tax. So all of this you have to be very, very careful, right? Then you have obviously the foreign exchange risk, which we have been discussing about. Then you have something called as political risk. What is this political risk? So when you make an investment from one country, India, into US, let's say tomorrow US says we will impose huge tariffs on all Indian companies, or US says we will not allow Indian companies money which is invested in US to go back to India. So there are regulatory and political risks that may happen in the host country. Okay. So this happened when India had issues with China post COVID or during COVID due to the Gablan issue. What happened? India did not allow Chinese companies to invest in India, right? So a lot of TikTok got banned in India because of that only. Same way you have a lot of companies, Xiaomi, quite a few other people faced troubles, right? So you have to be very careful. Such political risk is very, very high in international projects. Then you have changes in rate of inflation. So you would have gone through the Forex chapter where I explained interest rate parity theory, and where we discussed that exchange rates are a function of differential in interest rates or inflation, and I explained you all those formulae. You can go through that. There is a separate revision video also. Now, inflation rates. If you look at the advanced capital budgeting chapter, or if you look at any of your CA Inter FM chapters, we had very little idea of inflation. Advanced capital budgeting, yes, of course, but initially when you were doing FM, we didn't consider inflation. Whereas when you look at international projects, both the project cash flows also you have to consider inflation aspect, and currency also you have to consider inflation aspect, because currency gets affected by inflation. Then restrictions of remittance of cash flow abroad. I already told, countries may not allow. Then initial investment may be blocked. So initial investment, whatever you invest, right, they may not allow it to be taken for outside the country, or they may say there is a blockage of funds. They may say there are restrictions on how much money you can take. So how do you address that? We will see. There are some ways and means. Concessions in host country increase profitability. That is, sometimes there may be subsidies given by the host country that may have an impact on profitability. And elimination of estimation of terminal value is difficult. Estimation of terminal value is difficult because it is a different country altogether. How the project will survive, what will happen. So we don't know how the terminal value plays out. So this is why international capital budgeting is a very, very difficult process. Okay, I have done some evaluation of projects like this in Brazil when I was in my old organization. It was genuinely a very, very tough scenario. Now, what are the problems and solutions for foreign investment analysis? So, we discussed about these issues that arise. We will now categorize these issues as largely 4 or 5. 4. Forex risk. Okay, you addressed your forex risk by forecasting and adjusting for host country's inflation. That is, you forecast the inflation. You adjust the exchange rate of the host country by multiplying and dividing with inflation rates of host and home country. How do you do it? If you remember the formula also, there is this formula that we used. How do you do that? So, if you take a direct quote, so USD INR, right? USD INR is a direct quote. Let's take some number, okay, so 85, 90, whatever. I'll take some number called 85. Okay. Now, we multiply this with whatever is a direct quote mein, what is the base currency, what is the price currency? This is base, this is price. So, you multiply with price currency inflation divided by base currency inflation. Price or quote is same, right? So, this is how you arrive at it. Now, let's say you are a Mongolian company investing in Zambia. How will you compute? I mean, I gave you 85, so it is easily understandable for you. So, you have to remember this formula. Direct quote into 1 plus inflation rate of the price currency by 1 plus inflation rate of the base currency. Based on this, you have to compute the exchange rates, right? Then you have repatriation restrictions. That is, you may have issues where you may not be able to repatriate the money. So how do you overcome that? You do internal transfer pricing. You may do, most of you would have studied about transfer pricing in direct taxation, right? So those transfer pricing, using those transfer pricing rules and overheads, basically the home country entity, I am in India, I have invested in US, okay, I am an Indian company invested in US. So the US subsidiary will pay some charges to the Indian home parent for some kind of corporate overheads, for some kind of, the price at which, products are sold to India, or price at which the products are purchased from India. Right, let's say the Indian company manufactures something at 100 rupees. In market, it sells at 110. But as far as the US subsidiary is concerned, the Indian company will sell to the US subsidiary not at 120 but at 118. So most of the profits the Indian company is taken. So what you do is India, US, parent, subsidiary, seller, buyer, cost is 100. Okay, this 100 sale price, let's say for everybody else, sale price for others, sale price is 120. But for your buyer, what you do, you probably can charge slightly higher. And this buyer also, the US subsidiary, which is the buyer, it sells in its local market. What price it sells, I don't know. Let us assume it sells it at 140 because it is in US. So what you do is, instead of, even though you are selling it to 120 to other people in India, you will sell it to your US subsidiary at 138. Why? So that most of the money that you get out of this 140, you receive it in India, right? So that is, you sell to the subsidiary at 138, subsidiary buys from you at 138, most of the profit you yourself have taken. Now there are again transfer pricing guidelines, rules, all of that, that is an independent aspect. But this is one way to, actually look at and try and ensure that most of the profits can be remitted back to the home country and not retained in the host country. See what happens if, let's say, you sell it to them, to everybody else, you are selling it 120. To these people also, you sell it at 120. What happens? 120 to 140, 20 rupees profit. This 20 rupees, they keep it in US. But problem with US is, US says, no, I will not allow you to repatriate this 20 back. Even if you pay taxes, I will not allow. So instead of that, you charge them a higher price. Right, then you have blocked funds. Adjust in other projects and consider investment net of block fund. So sometimes they say this 20 rupees, what I showed, this 20 rupees is not permitted to be taken anywhere else. So what will you do with this 20? One way to handle this 20 is accumulate this 20 over multiple years, and let's say it becomes 200 over 10 years. This 200 you accumulate it and make an investment in another project. Okay, in the new project what you make an investment, you don't, whatever is the investment that is coming out of this blocked funds, right? This 200 is blocked money that is blocked by US. US is not allowing you to take it back. So this 200 you directly invest in another new project. So what is the cash flow for the new project? In cash outflow for the new project, basically the investment to be made for the new project. Assume that new project cost is 300. So new project cost is 300. Then old project blocked funds is 200. So when you evaluate this new project, you actually take it the cash outflow as only 100. Why? Because 200 is coming from blocked funds. So that is what we are saying here. Adjust another project, consider investment net of blocked funds. So before, do not use the blocked fund for other investments, and when you evaluate the new investment, consider only the additional amount that is being invested, not the blocked fund amount. Then dual taxation, higher tax rate for project evaluation, use higher tax rate. So sometimes what happens is you may have double taxation issues, or you may have withholding tax issues which you may not get credit for and all that, which is why when you're evaluating projects, always use a high tax rate. Don't use India ka tax rate on 25%. Please use a higher tax rate after adjusting for any withholding or double taxation and all. So these are the ways in which you handle the issues that arise out of international project ka evaluation. Now, please note two few important things. Project cash flows are different from parent cash flows. This I've told you also, because project may generate some money, but by the time it may come to the parent, there could be exchange rate issues, there could be taxation issues, because of which the amount that the parent is receiving may be less. Okay. Then investment evaluated only on basis of after tax cash flows to parent. So unless they specify in the question that please evaluate this project on a standalone basis, you are always supposed to evaluate a project on cash flows back to the parent, cash flows back to the home country, not the host country. Whatever money that has gone back, right? Whatever money that is gone back to the parent, based on that only evaluate the project. Okay, and always after tax, CFAT. If you remember, multiple chapters we looked at advanced capital budgeting, business valuation. Everywhere we use the term CFAT, cash flows after tax. Right. Then what do you do this? What is this whole new ratio, new interest rate? What is this whole discount rate? 1 plus risk-free rate plus 1 into 1 plus risk premium is 1 plus risk-adjusted discount rate. So the way you evaluate these projects is by considering a risk-adjusted discount rate. Risk-adjusted discount rate is used to evaluate these kind of projects. When you use risk-adjusted discount rate, how is the risk-adjusted discount rate arrived at? It is simply a product of 1 plus your risk-free rate of the country and 1 plus risk premium. Okay, 1 plus risk premium into 1 plus risk-free rate. Now, risk-free rates for different countries vary, but risk premiums also depend on the project and all of that stuff. So you have to be very careful. In fact, I think the question in November 24 related to this only. Okay, even though they didn't explain the question properly or give the question properly, this is what the question was pertaining to. Now, how do you evaluate using this risk-adjusted discount rate? First, you do this only when they specifically say, okay, please note these words. I am trying to highlight this again and again. You use this risk-adjusted discount rate approach only when they use the words evaluate international projects using foreign currency approach. Foreign currency approach this is the way you have to do, and they will give you the data. What do? Foreign currency cash flows are discounted using foreign currency RADR. That is, you are based in India, you are investing in US, you are getting some US cash flows. The US cash flows are discounted using a risk-adjusted discount rate for the US. And then the project is evaluated. That is the first step. Then compute the foreign currency NPV. So you compute the NPV of all the foreign currency cash flows, which are discounted at foreign currency risk-adjusted discount rate. Then convert to home currency at spot. So once they are all at present value, then convert them into today's spot rate. This is the approach itself is called the foreign currency approach, or in which the risk-adjusted discount rate is used. Okay, please remember this. We will be solving a problem on this, then you will understand this better. I've just thought I'll explain it to you briefly. See, this problem, this particular chapter, there are, as I said, 4 varieties of problem. We'll solve those problems. But more importantly, there is a good amount of theory also. Now, whether they will ask an exam or not, I don't know, but you have to necessarily be prepared. So what I would do is, I would go through 2-3 slides, then probably take up a couple of problems, then go through 2-3 slides, and I'll do a mix and match of that. Okay. Now, please note some more important aspects in foreign currency project evaluation. Risk cannot be adjusted both in cash flow and discount rate. It can be adjusted only in one. So you cannot have risk-adjusted cash flows being discounted by risk-adjusted rate. No, you can do only in one place. We discussed this in business valuation chapter also. Project inflation of host country using PPP. Purchasing power parity basically means inflation. Right. If inflation is not given, then what you should do, we will discuss. Forecast the exchange rate and apply it. That is what I will do. First, forecast the exchange rate. Adjust project cash flows limited to parent for political or exchange rate risk using certainty equivalents. Certain times they may give you certainty equivalents which you may have to use. So we have not seen any question like this in the material or in any of the past questions, but this is something that they say that if there are political and exchange rate risk, adjust the cash flows using certainty equivalent approach. In the certainty equivalent approach, we have discussed this in advanced capital budgeting ratios chapter. Okay. Now moving to the next aspect. Next aspect, we have something called as adjusted present value. What is this adjusted present value? Adjusted present value method is a method to evaluate projects where you consider three aspects. What are the three aspects? First one is present value of first one is present value of operating cash flow. So you are computing the present value of operating cash flows and you are discounting it at what? 1 plus KP. And what is K? K is cost of equity. So you discount the operating cash flow with cost of equity. Very clear? Then next you have present value of tax shield. What is this tax shield? Tax shield is basically the benefit that is accruing to this particular project because of taking debt. And what is tax shield value? Tax shield value is T. T means basically if the data is given, it is great. Otherwise, you compute the present value of all tax benefits. You be computing present value of all tax benefits. What is tax benefits? This T divided by 1 plus ID. What is ID? ID is pre-tax cost of debt of home currency. Pre-tax cost of debt of home currency. Okay. Please remember home currency. So the cost of debt of pre-tax cost of debt of home currency, you are going to use that to discount the tax shield. Same way you discount the present value of interest subsidies. Interest subsidies also you discount at the pre-tax cost of debt of home currency. So this is a very, very important thing. When we solve a problem, we'll understand. Please remember this part very, very carefully. Then, what are the various kinds of foreign currency instruments? So you have something called as foreign currency convertible bonds, FCCBs. These were a rage at one point of time, between around 2010s and all that. This was a very big rage. So what happens in this is, an Indian company issues a bond. They issue a bond outside India. Okay. They issue a bond to a person who is outside India, and the money that comes in also comes in foreign currency. It's called foreign currency convertible bond, FCCB. Now, because you are borrowing in foreign currency, you are supposed to repay in foreign currency. Interest also is supposed to be paid in foreign currency. So far, so good. What happens is, this particular bond is convertible into equity. So imagine you raise 100 million FCCB, and let's say today's exchange rate is some 85. So you get 85 into 100. 100 million is 10 crores, 10 crores into 85, 850 crores, 850 CR. Money comes into India. On this you have, let's say, 1% interest. Okay, every year you have to pay 1%. But after 5 years or 6 years, either you have to repay or you have to convert into equity. What you do is, today itself you decide that I will convert each FCCB into 2 shares at 150 rupees per share. What is current market price of share? Current market price of share is 30. Okay, even then you are saying I will convert it at 150. But why? Who is this fellow who is believing that they will, current market price is 30, you will convert it to 150? They are people who invest because they believe after 5 years, when this conversion happens, the share price will be 800. Oh, 800 rupees ka share at that point. Today it is 30, but in between it will become 800, and I am going to get a conversion option at 150. If the conversion option, and it is the option of the investor, the person who is investor, not the Indian borrowing company. So when that particular option is there, if the market price is, let's say, 50, I'll say I don't want to convert, give me my money back. If I say the market price is 5, then of market price of what? Of the share. I say I don't want. If the market price is 150, I may want, may not want. If the market price is 160, I say I definitely want to convert my shares and make that 10 rupees gain. So you basically are giving them an option to convert on a bond or a foreign currency bond, and on which they have a right to play on the equity share upside. Now, what is the downside? If suddenly the company, let's say the company's share price is 5 rupees. What do you mean? Today price is 30, after 5 years it is 5. What does it mean? It means that the company's share is not doing well, meaning company is not doing well. If company is not doing well, the company doesn't have money. At that particular point, your investors are coming and asking you back $100 million of loan that they have given you. So, it is a double whammy. Double whammy means both sides, left, right. Right, both sides you're getting hit. Your equity also is not doing well because your company is not doing well. On top of it, your old lender is coming back and asking 100 million of FCCB money back. Right, so FCCBs are a very dangerous tool actually. Right, if you honestly ask me, if a company is doing well, everything is well. Why is it well? Because the concept of leverage. When the company is doing well, if you were to dilute your equity, okay, if let's say the current market price is 30, if you were to issue equity, you have to issue a lot of shares, whereas you are saying I will issue debt of 850 crores and I will convert it at 150 rupees. So, my dilution is reduced to that extent. The extent of what? 30 to 150, I am reducing the 5 times better value I have got. So, dilution is 5 times lesser, right. So dilution is 5 times lesser. So, if you look at it from that perspective, it is very good. Bad thing, only when things are going very good, this will work out. If things are going bad, this will not work out. Advantage of FCCBs, flexibility to convert if equity share price is high or redeem if price share is low. Obviously, investor will redeem if high or investor will convert if it is high, redeem if it is low. Minimum fixed interest earnings. I said it is 1%, it can be 3%, 4%, 5% interest rate. Easily marketable. Because this has this conversion option, it is marketable. Advantages to companies. Lower coupon cost as equity component has high value. Correct. If normal loan is 10%, this FCCB loan is only 5%. Leads to delayed dilution of equity. I told you, instead of diluting today, you can dilute it after 5 years and at a much better price. If company is growing faster, dilution will be lower as the conversion price will be higher. Exactly what I said. Disadvantages of FCCB, forex risk on interest payment. So, if you borrowed this on rupees 85, suddenly rupees now is 120. All interest payments have to be made at 120, your repayment has to be made at 120. You all learned this in forex chapter, no? Right, forex risk on repayment if the bond is not converted. The bond has to be repaid and you are not able to convert into equity on case. Not only do you have to repay 100 million, you borrowed 100 million at 850 crore rupees, now you have to repay 1400 crores. Why? Because USD INR exchange rate has changed from 85 to 140. I am just giving example, theoretical example, okay. So, these are the issues that you will face, right. Then moving forward, like FCCB, unlike FCCB which has these problems, there is something called as depository receipts. You have something called as depository receipts. What are depository receipts? Depository receipts are basically an Indian company. Okay, they have not given too much detail in this particular syllabus. I will try and add some more information so that you get the context. It is not from exam perspective but context perspective. An Indian company will issue some shares. They will manage it through a depository in India. Think of ICICI, IDBI, some depository is there. So, the shares are issued and the shares are kept with the depository. But the shares are subscribed by foreign fellows. Foreign fellows give money in dollar terms to get these shares, but the shares are not given to them. Money comes in. Instead of shares, the depository allots them something called as a depository receipt. Each depository receipt is equivalent to 2 shares or 3 shares, something like that, right. So, the depository receipts are instruments which are denominated in foreign currency, which are listed and traded in foreign exchanges like NYSE and NASDAQ, and the money comes in foreign currency to India and against which the depository receipts are issued, and even though depository receipts are issued against this money, they are issued on behalf of they are issued against the shares. So, those are purchased from that money. So, money came, the money is converted, money came to the company converts it into shares through the depository, the shares are kept with the depository, instead of giving the shares, they give DRs, depository receipts to these foreign investors. So, for foreign investors, they get to invest in fast growing companies and they have to take this risk of foreign exchange risk is on the foreign company only. Whatever is the fluctuation in exchange rate, they only have to bear. Dividends also, when they are remitted from India, they are remitted to the foreign country investors, and the exchange risk on dividend is also has to be borne by the investor only. For Indian company, it is a super mechanism. I am getting foreign investment in foreign currency, but all my money, proceeds, everything is in rupee terms, my dividend is rupee terms, everything is rupee terms. Right. So, what happens? These offer US investors to invest in invest in non-US stocks. That is what I was telling you. So HDFC, TCS, bunch of them have ADRs. Avoids complexity of dealing in foreign stock market. So you want to invest abroad, there are so many formalities. Or a US person wants to invest in India, there are formalities. Directly buy an ADR of HDFC. Requires compliance with SEC. So randomly you and I cannot go and issue ADRs or GDRs. You have to go and comply with Securities Exchange Commission of US, who will say what all rules you have to follow, what are the compliances, what are the disclosures, what is the corporate governance. You have to follow everything. Created by depositing securities with custodian banks in issuer countries. So what I told you are the depositories in India. They have two people, one a custodian bank in India and a depository in US. What happens is the custodian bank in India creates this, collects the money and gets the shares and keeps it with them. They have a counterpart called a depository, which is in US. They inform the US depository, and the US depository issues the ADRs. So the ADRs are not necessarily issued by Indian depository. They are issued by the US depository and Indian custodian bank working together. Right. So you have two people who are working together and they issue this. Then ADRs may be listed on NYSE or traded OTC. Mostly they trade on NYSE. Okay. Otherwise, very few people want to do it on OTC. Now this is called American Depository Receipt. What is Global Depository Receipt? GDR. GDR is, if you do this entire activity and the money is raised, money instead of being raised from US is raised from global investor, and the shares or the deposit receipts are traded in Luxembourg. Luxembourg is a country in Europe, somewhere beside Belgium, France and Germany and all that, somewhere it is there. Okay, that country has an exchange where the GDRs are traded. Okay, instead of trading in US, instead of following SEC guidelines, you follow these Luxembourg Stock Exchange guidelines and you do following all of that and get the receipts listed in Luxembourg, then it is called as GDR. Most commonly used when raising capital locally in US and the rest of the world. Very similar to ADR. Listing is in Luxembourg Exchange. Till conversion, DGR does not carry voting rights. So please note, ADR and GDR guys are just holding a piece of paper which entitles them to the share. Only if they hold the share, they have a right to vote. When they don't hold the share, they don't have a right to vote. Usually it represents one or more shares or convertible bonds. So typically each GDR is 2 shares or 3 shares. When we solve a problem, we'll understand. I have actually put a good problem. Now what is the impact of these GDRs and ADRs in Indian capital market? Market shifting from Mumbai to Luxembourg. I think this is a very broad statement they made in the institute material, but that is not the reality. Everybody is not gone and issued GDRs. There are few companies which have done, but they have said this in the material, which is why I am repeating, even though I don't agree with it. There is arbitrage possibility in GDR issues. Arbitrage possibility is basically you have a GDR which is trading at a different rate as compared to the underlying shares. So if the share is 1000 rupees and USD INR exchange rate is, let's say, 100. 1000 by 100, it should trade at $10, but it is trading at $5. So it's a very undervalued in the market, so you can buy. I know there is exchange rate risk, but even after accounting for exchange rate risk, it is trading at a lower rate. So there is an arbitrage possibility. Indian stock market is linked to the rest of the world. Yes, obviously, when your companies are raising money from the rest of the world, your markets are linked. Improves pricing outcome for issuers. Because of this particular kind of GDRs, foreign investors are willing to take lower return or give you a better price. So Indian companies actively explore for GDR investment. If when they are looking for large money raise, they do look for GDRs, right? So this is aspect on GDR. We'll solve a problem, but before we go to the problem, I want to explain this concept called MIRR. This is also a very important concept, very interesting and fun concept. So all of you know that IRR is what we typically compute, but if you try computing, please try in Excel once how IRR is computed when there are cash flows with continuous sign changes. What do I mean by continuous sign changes is, let's say the first year, 1, 2, 3, 4, 5, 5-year project. First year, 0 year, you make an investment of 100. What is our typical understanding? You will have cash flows like 20, 40, 60, 20, 10, then 10. Okay, this is how normally we think. But for this, you can compute an IRR. Okay, you can use whatever is that present value factors. You can estimate, do interpolation, etc. All that you find out an IRR. It is possible you will get an answer. But if let's say this is minus 100, then you have here 20 minus 10, then you have 100, then you have minus 30, then you have 50. If you take a project like this with these cash flows, please try and see in Excel, when you compute an IRR, you will get more than one answer. Where there are intermittent cash flows, which continuously changing, and here I am talking about net net cash flow number. Okay, there may be revenues, there may be costs and all of that. When you adjust everything, finally it is positive or negative. I am talking about CFAT level. At that level, if you have continuously sign changes, you will have multiple IRRs. So there is a concept called modified internal rate of return, MIRR. It's a concept. In this particular thing, what you do is you compute future value of all inflows at reinvestment rate and present value of all outflows at borrowing rate, and you take the nth root of that. Okay, then you get a rate. Now, what is this reinvestment rate and outflows at borrowing rate? So what you do is for this minus 100, minus 10, minus 30, these are outflows. So you go and compute the borrowing rate. You go and check for the borrowing rate, whatever is the borrowing rate in that particular country where this project is being executed. You compute a present value. And when you compute present value, please remember you ignore this sign. Okay, please don't compute the present value of minus 100. Compute the value of 100. Okay. Compute the present value of all outflows at borrowing rate. This is the denominator. Then inflows at reinvestment rate. What are inflows? This 20, this 100, this 50. Whatever are the inflows that are coming into the project, you can reinvest them into the project. So assume that what is the reinvestment rate in that particular country, 10%, 11%, whatever. So you compute future value of those at these rates, of these cash flows at that reinvestment rate. Both of them ignore the sign. Okay, and then compute nth root of that. And what is n here? 5 years. So nth root, fifth root of that. You get a rate called MIRR. This is a modified internal rate of return. They have not asked a question so far, by the way, in the exam, at least in the recent past. But this is one good kind of question which, if I were examiner, I will ask. Okay. Unfortunately, I am not the examiner, so we don't know what will happen. But please remember what this is. You would have studied this in CA intermediate in FM. If you have not studied, I wanted to show you this. Okay. Then now let us go and solve a ADR GDR problem. Okay, so that you'll understand this concept very well. ADR, GDR related questions. Okay, one question only I'll solve. I'll not solve further questions. Even when we look at the P600 plus, I'll not explain you all the questions there. One question is sufficient to understand this particular topic of ADR, GDR. Then we will go into actual solving of these complicated other questions, what I was telling. Now, those we will go. Wright Limited has proposed to expand its operations for which it requires funds of $30 million. It requires $30 million. Okay, Wright Limited operations $30 million. Net of issue expenses which amount to 4%. Project value is 30 million, but it also has issue expenses which are 4%. So post the 4%, it needs 30. Please remember, these are the words that English language, you have to be very careful. 4% of the issue size. So if you have 104, 100 by 0.96. So you have to raise 104.166 into 4% is 4.166. You subtract, you will get 100. So if you have to raise 30, if you need for the project 30, how much should you actually raise? You have to find it out. It is proposed to raise the funds through GDR. It is considering following factors in pricing. Okay, the expected domestic price of the share is 300. Face value is 10 for each share. Current market price of share is 300. Okay, 4 shares underlie each GDR. So you issue a GDR, but each GDR represents 4 shares. Please remember this. Underlying shares are priced at 20% discount to the market price. So because you are issuing a GDR, and I told you GDR means, there could be the exchange issues and all of that. So when people issue GDRs, they don't price them exactly on the price of the share. They say, "Acha, hame bhi pata hai." We also know that there are GDR may trade at a slight discount. So when we are issuing itself, we will issue to it at a discount. So they are saying 20% discount to market price. Then expected exchange rate is $70 rupees per dollar. Okay, we will see. Compute the number of GDRs to be issued and the cost of GDR to Wright Limited if 20% dividend is expected to be paid with a growth rate of 20%. So what is the cost of this particular capital that is being raised? That is the question. And they have given dividend growth rate as 20% and 20% dividend expectation to be paid. What is 20% dividend? Face value by 20. Please don't forget that. Okay, we will come to the dividend part second. First, let us find out how many GDRs, what is the issue size and all of that. So market price of share is how much? 300. How many shares are issued for each GDR? 4. So 300 into 4, 1200. What is the GDR discount? That is, at what is the equivalent value of Indian shares for each GDR after the discount? 20% is the discount. So 1200 into 80% is 960. So each GDR you are going to issue at 960 rupees equivalent value, but the dollar rate is 70. So 960 by 70, you get $13. So you are going to issue each GDR at $13.71, right? Even though their value, GDR represents 4 shares whose value will be 1200, 1200 by 70 is how much? 1200 by 70. It's probably 17.1, you are issuing it 13%. Why? Because 20% discount. Now, what is the total funds required? You are required to raise 30 million, but 30 million is a net fund. You need to raise gross of 4%. So, 30 by 96%, you get 31.25. So, if you raise 31.25 of that 4% money, 31.25 into 4% is 1.25. So, you have to subtract both, you get 30 million. So, you have to raise 31.25 to get 30. Then, how many GDRs are issued? That is the first question. That is what they said, right? Compute the number of GDRs. You have to raise 31.25 and each GDR is $13. So, you divide 31.25 million by $13, you get 2.278660 million or 22,78,660 GDRs. You have to give the answer in absolute number. Do not make the mistakes of saying 2.28 million GDRs. I have told that now, but I have told that just for ease of explaining. But 22,78,660 is what you have to actually write in the exam hall. Now this is the first part of the question. Second part of the question is what? You are paying some 20% dividend, growth rate of 20%. So what is the cost of this equity? What do you mean by cost of equity? If you remember the formula what we have, P0 equal to D1 by KE minus G. If you take it the other way around, right, KE is equal to D1 by P0 plus G. So, you can use this particular formula and arrive at cost of equity. So, what is happening? What is D1 here? What is first of all dividend here? Dividend they said is 20% of face value. But each GDR has 4 shares. So, 20% of and face value is 10, correct? Face value is 10. So, 20% of 10 is 2 rupees. 2 rupees for 4 shares makes it 8 rupees. But 8 rupees is D0 or D1? Please be very careful. Compute the number of GDRs to be issued, cost of GDR to write. If dividend 20% expected to be paid, so 8 rupees itself is D1, 8 rupees is not D0. So, be very, very careful. So, D1 by P0 plus G. So, 8 by P0. What is P0? The price at which you issued the GDR is 960. So, 8 by 960 plus 20%, which is a growth rate, you get 20.83. You get 20.83. This is one way, but please note I have done this in 2 ways, which is gross of flotation, net of flotation. So, even though institute doesn't specify this, I always do this because I don't know what in some questions they have done gross, some questions they have not done net. Okay, which is why when this kind of question comes, I suggest you solve both gross and net and give the answer. Whatever examiner wants, they will take. Okay, what do you mean by net? See, out of this 960, whatever you have issued, you have not got the entire money. 4% money is lost, right? Because 960 is the issue price, 20% discount. But out of that, you got 4% lesser. So, you subtract that 4% and arrive at a price of 921. Then you do the entire same exercise, 8 by 921 plus 20, which you will get 20.868. So, they should specify in exam gross of floating cost and net of floating cost. And where is floating cost adjusted? Floating cost adjusted in the price of share, which is D1 by P0. In that P0, it is adjusted. Right. So, this is how you solve this problem. Now, what are the characteristics of depository receipts? First one, holders participate in economic benefits, have no voting rights. I already told you, US people invest in India, but they can't vote. They are settled through CDL and Euroclear international book entry system. There is a settlement mechanism. GDRs are listed on London Luxembourg Stock Exchange, ADR are listed on NYSE. Trading takes place between professional market makers on OTC. If it is not on exchange, professional market makers on OTC. Instruments are freely traded, yes. They are marketed globally in more than one currency, yes. Exchange risk on the instrument and dividend is with the investor. This is what I was telling you. The dividend has to be converted and paid to the investor in their own currency terms. So, exchange risk is with them. The Indian person is not saying I will pay you $5 dividend. They are saying I will pay you 5 rupees dividend. If that 5 rupees give you $1, $10, $100, I don't care. GDRs may be cancelled anytime after a cooling period of 45 days. So, you can cancel GDRs also. Overseas depository requests domestic custodian mind to cancel GDR and get underlying shares released in favor of the NRA investor, non-resident investor. So, instead of holding GDR, you can convert the GDR into the underlying shares. So, non-resident, again you have to follow FEMA rules, everybody cannot convert. A non-resident holder may get converted if they follow the guidelines. The price of shares on BSE, NSE and the rate of the advice of redemption shall be taken as cost of acquisition. So, what is cost of acquisition? Whatever is the price of the share on BSE, NSE on the date of request is considered as the cost of acquisition of that particular share. Right. So, this concludes the GDR part. Now, before we get into this foreign investment related questions, I want to finish a couple of more types of varieties of bonds, how people raise money in foreign currencies, and then we will go to this part. Then we will go to problems, and then there are some very important topics in this. I completely actually forgot. International Financial Center. Question was asked on this. Question was asked on gift. So this and sovereign wealth fund, this is a new topic that has been added. So please be very careful this also. So we will look at all of those, but first let us finish these other bonds, then we will go into some questions where we will solve the questions on, because we already solved GDR, we need not solve it again. International investments, we will solve a question, or one or two questions, and we will solve a couple of one or two questions on MIRR if it is there, and then adjusted present value, and then we'll come back to theory aspects, because this chapter has good solid theory also. Okay, chalo, let's move forward. Let us look at these other kinds of foreign currency instruments that are issued for making investments. First one is something called as euro convertible bonds. So what are these euro convertible bonds? Bonds issued by Indian companies in foreign market, okay, have an option to convert into predetermined number of equity shares of the company, carry fixed rate of interest in conversion price. So this is like FCCB is a type of euro convertible bond, correct? They may carry one of the two options. They may have a call option or a put option. Now, FCCB may, there is only one option, which is convertible at the option of the investor, not the issuer. Here in a euro convertible bond, you have two options. They can be call or put. What is call? Call means the person who has issued has a right to bring back the money. Put means the person who has invested has a right to sell it back, right? Call option, the issuer can call the bonds for redemption before the date of maturity. Okay, if the share price is appreciated substantially, the issuer company can exercise the option, forces the investor to convert the bond into equity. So this is an option which works in favor of the issuer. That is, if the share price has gone up substantially, I will say, chalo, I will repay the loan. Why? Because my share price has gone up. Why should I allot you shares at a low price? Why should I convert your loan into shares at such low price? I will probably dilute 1%, get the money, pay off your loan. So such kind of bonds will try and convert into equity far earlier. Put option, that is, a bondholder has a right to ask the money back. So enables bondholder right to sell his bond to the company at a predetermined price and date. So on a specific date, I have a right to sell my bonds to you. If the share price is going down and my conversion option is waste of time, so I will sell my bonds back to you, you give me my money. The payment of interest and redemption of bonds will be made by the issuer company in US dollars. So you'll have to repay the bond. This is a euro convertible bond. Then there are other debt routes for foreign exchange funds. What are these other debt routes? You have something called as euro bonds. What are these euro bonds? These are long-term bearer bonds issued offshore in a currency other than issuer's country and can be fixed, floating or convertible. That is, long-term bearer bonds issued offshore in a currency other than issuer's country. So India is issuing a long-term US dollar bonds which are either fixed, floating or convertible and are bearer bonds. These are called, long-term means 10 years and all, are called euro bonds. Then you have euro convertible bonds, which euro convertible zero coupon bonds. Euro convertible zero coupon bonds. What are zero coupon? There is no interest coupon. Everything, if you remember the chapter security valuation fixed income portion, the interest is a part of the price. That is, there is no separate interest that is paid. The bond is issued at a deep discount and the interest accrues on the bond and it is repaid at full value. Zero coupon bonds, conversion on maturity usually 5 years at a predetermined price and treated as deferred equity issue. So it is not only simple zero coupon bond, it is euro convertible zero coupon bond. Okay. Then euro bonds with equity warrants. So what are equity warrants? Basically options. So they carry a market determined coupon rate, normal coupon, whatever is market. The warrants are detachable and pure bonds are traded at a discount. So the warrants are traded independently based like options and the bonds trade independently at discount. Fixed income funds management may like to invest for the purposes of regular income. So because these are market coupon rates, fixed income funds managements, that is people, large bond traders may want to invest in this. Then you have euro commercial paper. These are basically short-term money. Short-term money market securities issued at a discount for maturities less than 1 year. Okay, even in India you have commercial paper, same thing. What we studied in equity security evaluation chapter. Syndicated bank loans. Traditional way of raising funds from banks. The interest rate set with reference to an index like LIBOR plus spread. Now there is no LIBOR, it is SONIA so far plus spread, depending on the borrower credit rating. Covenant set by lending institution like maintenance of key financial ratios. So you can borrow, so let's say India, there is a project. You can say, I want to borrow from 4 or 5 banks, JP Morgan, Morgan Stanley, Goldman. They are going to give me $1 billion and the interest rate is SONIA plus 5%, plus 500 bips. Okay, and I'll have to maintain certain covenants. Then you have Yankee bonds, Samurai bonds, Bulldog bonds. What are these all fancy names? Yankee bonds means denominated in USD, issued in USD by foreign banks and corporations and are usually registered with SEC. So Indian company going and issuing a bond in US is known as Yankee bond. Indian company issuing a bond in US for US investors in US dollar currency is called as a Yankee bond. Then you have something called as Samurai bond. Samurai is what? Samurai, Japan, right? So bonds denominated in yen and issued in Tokyo by a non-Japanese borrower. Indian company RIL goes to Japan and issues yen denominated bonds to Japanese investors to collect yen money is called a Samurai bond. Then you have something called as Bulldog bonds. What is Bulldog? British Bulldog, right? So foreign bonds issued by non-British corporations, RIL, is seeking to raise GBP from British investors. So RIL goes to England and issues a GBP denominated bond. It is known as a Bulldog bond. Then what about India? You have something called a Masala bond. What's a Masala bond? It is a rupee denominated bond. In all the three cases, RIL is going outside and issuing in their currency, whereas here it is ulta. RIL is issuing a rupee denominated bond for US investors. So, rupee denominated bond issued by an Indian entity in foreign markets to raise money in INR. So, RIL, if it issues a rupee denominated bond in Hong Kong, Singapore, London, Tokyo, New York, wherever, Amsterdam, Luxembourg, everywhere. But a rupee denominated bond issued outside is called a Masala bond. Whereas a RIL issuing a US bond is called Yankee bond, RIL issuing a Japanese bond is called Samurai bond, RIL issuing a British GBP denominated bond is called as a Bulldog bonds. Interesting names. Okay. Then we will come back to all these other aspects. I wanted to first discuss this aspect, foreign investment questions. How do we solve the problems, illustrations on foreign investment, where you have, investment is made in one country to other country, comes in, goes out, cash flows and all that. Identify projection currency. First thing you have to identify is what is the currency in which projections have to be made. That is, where are the project cash flows. So, what is the currency for that? And then compute the currency rate. So, if you have to compute the currency exchange rates, because whatever is that particular country's cash flow, that eventually will come back to the home country or the parent country. So, if you don't forget, you don't remember home, use the word parent. But at what exchange rate? So, you have to first find out exchange rate. And exchange rates, I explained to you about interest rate parity, the parity theories, right? If you have inflation rates and they have given you inflation rates, use those. If they have not given you inflation rates, as a second option, use interest rates. If they have not given, please, I am being very specific. Please, very, very specific. If they have not given you inflation rates, then use nominal interest rates. Then use currency for P&L projections where required. So, in the P&L, if there are, flows from one country to another and all of that, if at all currency is there, currency rate is to be used, use it. Then ensure revenues and costs are on nominal or real as per question. Now, this is a very important thing. You would have seen this in Advanced Capital Budget Generation chapter. You have to be very, very clear as to what is the way in which you have to make your projections. Are you making real cash flow projections or are you making nominal cash flow projections? Because if you are using real cash flow, discount rate has to be real. If you are using nominal, you have to use nominal discount rate. Please remember, if you remember in that RADR, I was explaining you some concept, no? RADR, I think in the first slide or second slide. Evaluate international project using foreign currency approach, where 1 plus risk-free rate into 1 plus risk premium is equal to 1 plus RADR. So, risk-free rate into risk premium. Here there is no concept of notional, real and all of that. Don't unnecessarily get confused. Okay, that is different, this is different, right? Right. Ensure revenues and costs are near real or nominal as per the question. Then check for taxes. So, once you've identified those taxes, adjust for those taxes. Once you've identified, then adjust tax credits. Then identify what is the actual remittance that is allowed to the home country. Post-tax, what is it? And then compute FCFF, FCFE depending on what it is. Okay. Before you come to FCF, FCFE, you should have clarity on everything. You should have clarity on exchange rates, revenues, costs, inflation, interest rate, taxation, actual remittance. Okay. All of these you need to have clarity. Then check for working capital release. So, what happens is, if you make an investment, towards the end you get a release of working capital. Whatever you invest now, maybe you get some money back at the end. That also you have to factor in. Then compute NPV. And there are also some cases where there are block funds. So, you have to adjust for block funds also. Finally, compute NPV. And then make an investment decision. You make an investment decision after doing all these adjustments. So, I have listed down these adjustments. When we go into a problem, we will understand this. Okay. So, now, before we proceed to the other aspects, like what I said, right, there are other aspects of IFSC, sovereign wealth fund, what are the other things that are there? cash management, all these are, very quickly we can finish, nothing fancy. In cash management also, a very simple question, you can solve this, there's nothing much. This all get over very quickly because this is largely theory and there is nothing too deep in it. Okay, problems are the real thing. Okay, so let us go and solve some problems, and we will look, because we already solved the GDR problem, we will not be going to that, but we will be looking at other problems, APV, MIRR and other problems on international investment. Okay? First we will solve the kind of problems what I want you to prepare for. Okay, GDR is one, and there are some other similar stuff. First we will solve those problems, then we will go to problems which I don't want you to solve in the exam. I will solve them in this revision also. Okay, first one is this illustration number 5. Is again, most of the stuff is taken from study material and past exam. This is a study material question. Opus Technologies, an Indian IT company, is planning to make an investment through a wholly owned subsidiary in a software project in China with a shelf life of 2 years. The inflation in China is estimated as 8%. Please note, these are the keywords. Okay, I will not highlight everything, I will highlight only important things. China inflation 8%. Operating cash flows are received at year end. Okay. For the project, an initial investment of Chinese yuan 30 lakhs will be required. Investment of 30 lakhs. Okay, please be very careful with the decimals and commas and all that. The land will be sold after completion of the project, an estimated value of CNY 35 lakhs. So you bought for 30, sold for 35. And what is the project duration? The project also requires an office complex at cost of 15 lakhs payable at the beginning of the project. Okay, the complex will be depreciated on a straight line basis over 2 years to a zero salvage value. The complex is expected to fetch CNY 5 lakhs at the end of the project. Is the end of the project 2? So they said the life of the project is 2 years. Please remember. The company is planning to raise required funds to GDR issue in Mauritius. Each GDR will have 5 common equity shares of the company as underlying, which are currently trading at 200 per share in the domestic market. The company has currently paid dividend of 20, currently paid, so last year 25%, expected to grow at 10%. The total cost is cost of issue is estimated to be 1% of issue size. Okay. Annual sales are 10,000 units at the rate of CNY 500 per unit. Price is expected to be to rise at the rate of inflation. What is the rate of inflation? We noted down 8%. This is why I said remember inflation. Variable operating costs are 40% of sales, fixed costs will be 22 lakh per CNY per annum and expected to rise at inflation rate. This also will grow at inflation rate. Tax rate applicable in China for income and capital gain is 25%, and as per GOA policy, no further tax will be payable in India. No tax nuisance. The current spot of CNY is 9.5 rupees per CNY. CNY is Chinese yuan. Okay, and the nominal interest rate in India and China is 12% and 10% respectively, and the international parity conditions hold. So you see, they have given inflation rate for China, they have not given inflation rate for India. So what did I say? When they give, if they don't give you all inflation rates and give you only interest rates, then nominal and parity condition hold means you have to compute the exchange rate using the nominal interest rates. You are required to identify the expected future cash flows in China and determine NPV of the project in CNY. So everything in CNY. Determine whether Opus should go for the project, assuming that there's a restriction on transfer of funds from China to India or any other charges or taxes on transfer fund. So if at all there is no problem in moving funds, should you invest or not? So this basic data, right? How many units? So there are two parts in this question. One is GDR related stuff, one is project related stuff. What is GDR related stuff? They said 5 shares make a GDR. Each share is 200 rupees. So all shares is 1000 rupees, right? Then they also said paid a dividend of 25%. They didn't say any discount or anything. What is the dividend on that? And they have said trading at this and face value of 10. So 5 shares of 10 is 50 rupees, correct? On that they are paying how much dividend? They are paying 25%. 50 by 25% is 12.5. So 12.5 is the dividend that is paid on a 1000 rupee GDR. Then growth rate of this is 10%, right? Because they said growth rate is 10. So next year the dividend is 13.75. So D1 is 13.75. So if you have D1 as 13.75, what do you do? I don't know. Let us see. Okay. Then what do we see? Then they said variable cost this. How much money do you require? Initial investment of 30 million and office of 15 million. So you require 30 lakhs and 15 lakhs. So 45 lakhs is what you are supposed to raise, right? 45 lakhs. Now what do you do? What is the flotation cost? Flotation cost is 1%. So this 1000 rupees, whatever you are raising, right? Out of that you get only 990. And what did they say? They said gross, net or whatever, right? Estimated issue cost is 1% of the issue size, so not said net. So 990 rupees is the actual money that you will receive when you issue a 1000 rupees GDR. So what is the cost of equity? Why are we finding out cost of equity? Because at what rate will you discount? See, this is a wonderful question. They have only said the inflation, the interest rates. Do you discount interest rates? No. Interest rates are given for the purposes of your computation of the exchange rate. The discount rate you have to find out. That is why they have given the GDR value. See, very interesting, right? So D1 by NP plus G. So 13.75, which is dividend, divided by net proceeds, which is 990, plus G of 10%, you get 11.39, which is the discount rate. Now, the first year 30 lakhs and 15 lakhs is the investment, which is basically the total investment of 45 lakhs CNY. Then what do you get? This on this 15 lakhs, every year you get depreciation of 7.5. We will see what the depreciation. Then they said how many units will be sold? 10,000 units at the rate of 500 per unit, right? And for 2-year period. So 10,000, first year the price is 500. So this is a very, very important aspect you need to remember, which is why I don't like problems in this chapter. Annual sales expected at the rate of CNI per unit. The price of unit is expected to rise at the rate of inflation. So you have to assume that year 0 the price of the unit is 500. Some of you may assume that the year 1 price is 500. So that is why it is a very dicey chapter because assumptions play a very large role. So first year 500 into 1.08, second year 500 into 1.08 whole square. So you get 540, 583. Total sale is 10,000 into 540, 10,000 into 583, you get 54 lakh CNY and 58.32 lakh. From that you subtract 40% cost. So directly remove 40% of 54, you get 21.6 is the cost. From that you again subtract fixed cost. What is the fixed cost? See here, they said fixed cost again is a nuisance here. Fixed operating cost will be CNY 22 lakhs per year and expected to rise at the rate of inflation. Now, do you take fixed cost for the 0th year or no? Now, fixed cost, is it incurred in the 0th year? No. Value of fixed cost in the 0th year is 22, but it is 23.76 in year 1. So, this 22 is taken for computation purpose, not used for cash flow purpose. Okay, 23.76, 25.66. Then you have depreciation. We already computed the depreciation here. 7.5, 7.5. From that, subtract depreciation, you get profit before tax of 1.1, 1.83. From that, they gave a tax rate of 25%, subtract 25% tax, you get PAT. This is the PAT. Now, to PAT, you add back depreciation. Depreciation plus PAT, you get the CFAT. Then, you have 45 lakhs as the initial investment. And then, are the only cash flows with respect to the P&L? No, there are, you have land at 30 which you are selling at 35. There is an office building at 15 which you are selling at 5. So, on this 5 lakhs, there is a tax, and post-tax there is a inflow. On this differential, there is a tax, but the entire 35 will come to you. So, what you do is, you first compute complex sale value is 5. From that 5 you subtract 25%, 1.25, you get 3.75 as the net inflow from sale of the office complex. 35 and 30, the gap gain is 5. From that 5 you subtract 1.25 which is tax, and you get the total cash inflow from sale of land, which is 33.75. So, you take this 3.75 and 33.75, you get some 37.5. So, this 37.5 is also an inflow. This 37.5 is also an inflow. After you do this exercise, which exercise? Investment outflow of 45, then you have FCF, which is your 8.5 plus 7.5 and 1.3 plus 7.5. You also have to add this 37.5. That is when you will get the entire cash flows. Okay, and then you compute the present value factor at the rate what we have given, 11.39%. Right? Compute the present value factor and you arrive at present value. First year 45, second year 8.3 into 7 into 0.89 and 46 into 0.8, you get some values. So, you get an NPV in CNY which is equivalent to CNY equivalent. Please remember, this is in CNY. They have asked us to compute in CNY, which is 0.12 minus 0.12. What does the question say? Question clearly says, identify expected future cash flows in China and determine NPV of the project in CNY terms. So, we have got this in CNY terms. Okay. Now, determine whether they should go for the project or not, assuming that there are neither restriction on transfer or any charges payable on transfer of funds. So, this is from a CNY perspective, but from an INR perspective, what will happen? What is the initial investment? First year, you have 9.5. Second year, 9.67. Third year, 9.85. What are these? These are currency rates. Where did I get these currency rates from? Working note. What is the working note? What is the working note? Even though they have given inflation rate of 8%, this is irrelevant to us. What is relevant is 12% and 10%. First year value is 9.5. So, 9.5 into 1 plus 12% by 1 plus 10%. Then you get 9.67. That into 1 plus 12 by 1 plus 10, you get 9.85. So, those are the exchange rates you use. And please note here, the question, there is neither restriction on transfer of funds nor any charges. So every year they transfer funds. So imagine every year there is a cash flow. So first year 45 is an outflow, 45 lakhs of CNY into 9.5 exchange rate is outflow. But next year 7.5 and whatever we got here, present value multiplied by 9.67, then 37.375 multiplied by 9.85. You get a cash inflow in rupee terms, this many lakhs. You compute, add all of them, you get present value of 13.17. Right. So now this is one way. Now if instead of this, you compute present value at 12 lakhs, at 12%. Why will you compute present value at 12%? Because, and why 12%? As I said, nominal interest rate. The discount factors are these. The CNY cash flows are 45, 8.3 and 46. What are these? Here whatever value we got now, 45, 8.355 and 46. Take these values and you multiply them at the present value. And then of course multiply with the exchange rate, INR exchange rate, and then you see you get an NPV in INR terms of 8.78. When you do it at 11.39, you got a NPV of 13.17. Whereas when you do it at 12, you got 8.78. Now there are too many assumptions in this question, whether you should do it that way or this way, right? Which is why if such a detailed question comes, even though it appears simple, please be very, very careful. Okay, if you don't have any other option, solve this, but otherwise I would strongly advise you to leave it. ABC Limited is considering a project in US which will involve an initial investment of US dollar. How many zeros are these? There are 6 zeros. So 11 million. Okay. The project will have 5 years of life. Current spot exchange rate is 48 per US dollar. Risk-free rate in US is 8%. The same in India is 12%. Cash flow from project is as follows. Calculate the NP of the project using foreign currency approach. What is foreign currency approach? 1 plus risk-free rate into 1 plus risk premium is equal to 1 plus RADR. Okay, this is first. And what do you do in this? Evaluate international project using foreign currency approach. Free foreign currency cash flow discounted using foreign currency RADR. So you have to find out foreign currency RADR. Compute the foreign currency NPV, convert to home currency at spot. Okay, do everything in foreign and convert. Okay, this is what you're supposed to do. So initial investment is how much? Initial investment is here 0, 1, 2, 3, 4, 5. 2, 3, 4, 5. Minus 11. After that it is 20, not 20, it is 2. That's what you should not get confused. 20 lakhs. Institute is very bad in this year. 2, 2.5. This all is million. Okay, either you give in lakhs or you give in million. Let me put actual numbers. That way we'll avoid nuisance. 11 million. Then 2 million. Then 2 million 500,000. Then 3 million. Then 4 million. Then 5 million. Then if you have to use the foreign this approach, the risk-free rate in US is 8%, same in India is 12%. Now ABC is Indian company. So, and they are investing abroad. So everything has to be discounted, computed, all cash flows have to be discounted in abroad using foreign currency discount rate. Right. Calculate NPV, the required rate of the return on the project is 14%. Right. Now, what is the foreign currency RADR? That is the primary question in this, primary issue in this question. Okay, I'll write solution here. Okay, before we year cash flow. Okay, this is just a working note for your guys, for your sake, year cash flow. So what I'll do is first I'll go and write a working note. Working note 1, RADR India. What did they say? RADR India is 14%. Correct? They themselves are given in the question. Okay, and nominal, not nominal, risk, they said risk-free rate. RF India. RF India is 12%. So what is risk premium India? It is 1.1 plus 12%, which is the risk-free rate, into 1 plus risk premium is equal to 1 plus 14%. Okay, so India risk premium is equal to 1.14 divided by 1.12, okay, minus 1. So into 100, that is 1.78%, 7857 or 786%. Okay, this is the risk premium. This risk premium will stay constant even in the US. So, US RF is equal to 8%. That's what they gave, right? 8 or 10. What did they say? US risk free rate is 8%. Risk premium is equal to 1.786%. US RADR is equal to 1.08 into 1.01786. That is equal to divided by 100 plus 1 into 1.08 is equal to minus 1 into 100. That is equal to 9.928929%. 929%. Okay, I am taking everywhere 3 decimals. So, US RADR is 9.98. Why am I bothered about US RADR? Because if you come back, foreign currency cash flow has to be discounted by foreign currency RADR. So, that is the key point in this question. So, foreign currency cash flows have to be discounted by their RADR and the risk premium stays constant. So, to the foreign currency risk free rate, you multiply, basically you add the risk premium to arrive at the foreign currency RADR. So, this is the interesting part of this question. So, this is the discount rate. Now, this discount rate you will apply here, where present value factor at 9.929, I will say 9.93%. So, 1 by 1.0993 is equal to, this is 1, this is 0.9097 is equal to 0.8275 is equal to 0.7528 is equal to 0.6848 is equal to 0.6229. So, 0.6229. This you will arrive at the NPV. NPV is equal to minus 11, or if I will do all of this, 2 into 0.9097 is equal to M plus 2.5 into 0.8275 is equal to M plus, then 3 into 0.7528 is equal to M plus, 4 into 0.6848 is equal to M plus, 5 into 0.6229 is equal to M plus. If you do memory recall, you get 12. So, these all put together 12.00025 and this is minus 11. So, you subtract 12 minus 11, it is 1. So, 12.00025 minus 11 at 1.00025. Okay, so you get 1.00025. If you take 3 decimals, if you instead of taking it 9.93, you take it at 9% or 9.9%, you'll obviously get a slightly different answer, but broadly this is going to be the answer. So 1.0025. Now what is this 1.0025? You find out, you discount the cash flows using foreign currency RADR. Foreign currency RADR, whatever is that, you arrive at an NPV. That NPV you convert at spot rate. What is the spot rate? They have given spot exchange rate is 48. INR NPV is equal to 1.00025 million into 48. That is, you get 4 crores 80 lakhs 12,000 rupees or rupees 48.012 million. This is the answer. Now, if you look at the material, there is a slight variation primarily because of decimals that I have counted. I have taken more decimals, okay, to be more accurate. So, this is a problem on RADR and the risk premium remains constant, but the risk-free rates change. Using that, you arrive at RADR. That is the concept. Now, we have solved this question. Then let us move to the next question, which I want to show you. Now, let us look at this question. This is a question on MIRR, which I wanted to show you. Illustration 10 in the seminar P600 plus. It's also steady middle question. XYZ, a company based in India, manufactures very high quality modern furnitures and sells to a small number of retail outlets in India and Nepal. It is facing tough competition. Recent studies on marketability of the products have clearly indicated that the customers are now more interested in variety and choice rather than exclusivity and exceptional quality. So, the cost of quality wood in India is very high. The company is reviewing the proposal for import of wood in bulk from Nepalese supplier. Last line is only important, everything else is irrelevant. Their company based in India, sells furniture in India and Nepal, wants to import from Nepal. Okay. Estimate of net Indian and Nepal currency cash flows in nominal terms. Please note, nominal means including inflation. In this given below, net cash flow. In Nepal, in Nepalese currency, you have cash outflow of 25 million in year 0. Then you have inflows 2.6, 3.8, 4.1. In Indian rupee terms, the inflows are 2.8, 4.2, 4.6. What are these two from? These two are basically from sales. The following information is relevant. XYZ evaluates all investment using a discount rate of 9%. All Nepalese customers are invoiced in NC and NC cash flows converted Indian on forward rate and discounted the Indian rate. Okay. Please remember, NC converted into INR, INR discounted INR rate, which is what is the INR rate? They themselves have said here, 9%. Okay. Then inflation rates in Nepal and India are expected to be 9%, 8%. Nepal is high, India is low. So let us look at the exchange rate. The current exchange rate is 1 rupee is NC 1.6. So please remember, direct quote spot into 1 plus domestic by 1 plus foreign. This is the way exchange rate is computed. What is direct quote? USD INR. That is, or the other way, what I said, 1 plus price currency interest by 1 plus foreign currency interest for direct, for not foreign currency, base currency interest for direct quote, right? USD INR is direct quote, that is per USD how many rupees. Here what is the quote? 1 rupee is equal to 1.6 NC. That is, what is the base currency? Base currency is INR. So base currency is INR means, base currency is INR means here 1 plus price currency. Price currency is Nepal. So Nepal's inflation rate is how much? 9% divided by India base currency. Base currency is INR by 1 plus 8% into 1.6. This is how you compute for the first year. Okay. Then assuming that you are finance manager of XYZ, calculate NPV and MIRR. This is why I wanted to solve this problem. How is MIRR computed? You may use the following values with respect to discount factor for rupee 1 at 9%. They have given the 9% present value, future value. Why are future value is given? We will understand. So first year 9% and 8%, I told you 1.6 multiplied by 1.09 by 1.08. So you get 1.6148, 6298, 6449. Okay, this is a simple computation issue. I already explained you the logic. Then what are the cash flows? Cash flows are 25, 2.6, 3.8, 4.1, minus 25, 2.6, 3.8, 4.1. And they said all cash flows are converted into INR. So please divide by the respective respective exchange rate, 1.6, 1.6148, so on and so forth. You will get these as the INR cash flows. To this, you add INR cash flows, which are this. How did I get this? They themselves have given the question. These are the INR cash flows. Take those, add both of them, you get some value, total cash flow. This is the cash flow, right? This cash flow, you have to discount at 9%. Why? Because they themselves said use 9%. When you use 9%, you get minus 15, 4.1, 5.4, 5.4, you get minus 4, 5 point, minus 0.5425 is the NPV. NPV is negative. NPV is negative. Now let us see. They said compute NPV and MIRR. What is MIRR? MIRR is, you take the cash flows, you consider two rates. One is the borrowing rate, one is the reinvestment rate. Now what is the borrowing rate here? Have they given anything? Inflation rates they have given, we cannot do anything. Then they have said evaluation of investment using discount rate of 9%. So you can take the discount rate of 9% as the borrowing rate. So that can be taken as borrowing rate. But what is the reinvestment rate? How will you figure out what is the reinvestment rate? So they have given present value and future value both at 9%. And they have said that inflation rates, that's it. They have said discount rate is 9%. How will you now compute reinvestment rate and a borrowing rate? You don't have both of them. So you will take the same 9% as reinvestment rate and borrowing rate. So you see here, reinvestment rate also 9%, borrowing, financing or borrowing rate also 9%. So this cash flow first year, you take it at same value because first year anyway cash flow doesn't matter. Subsequent years, you compute the future value. What is the future value factor they have given? Because subsequent items are inflows. Inflows are taken at future value, outflows are taken at present value. right? So outflow present value factor first year 1, so 15 point whatever that 625, that is taken independent of the sign, and these you multiply with the future value and arrive at a sum of future value which is 19. So 19.5332 divided by 15.62, that is what you do, and whole thing you do a cube root. Now if you come back and ask me, sir, how will I figure out cube root? I have explained to you how you can find out a cube root using a calculator also. What are the steps? If you recollect, to compute 10th root, what will you do? First let us find out the value of this number, then we will find out the cube root. Numerator, future value of inflows, denominator, present value of outflows. 19.5332 divided by 15.6250, you get a value of 1.2501 something. I will just store it in memory. Okay. Then write, what are the steps to compute a root? Write the number on your calculator. I have already written. You have to write the number and press square root 12 times. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Then you have to subtract 1. Okay. Then you have to divide by n. If it is nth root, you have to divide by 10 or multiply by 1 by 10. For us it is what? For us the root is 1 by 3. So you divide this by 3. Okay. Then to that you add 1. You get a value. That you multiply into is equal to 12 times. Into equal to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 1.07725. 1.07725 is 7.725%. 7.725%. Though NPV is negative, it should not proceed further because NPV is negative because your MIRR is lower than your 9% rate. Okay. So I wanted to specifically show this question so that you know the concept of MIRR. If it is asked in the exam, 6er, okay, we can hit a 6er right out of the park. Now we will solve a question on APV, adjusted present value, okay, because I wanted to show you that it is, what is APV if you recollect? Sum of operating cash flows discounted at cost of equity, sum of subsidy and tax shield discounted at cost of debt, pre-tax or post-tax? Pre-tax or post-tax? Pre-tax cost of debt of home currency. Pre-tax cost of debt of home currency. You should not forget this. That is why I wanted to specifically show pre-tax cost of debt. Both these are pre-tax cost of debt and the operating cash flow is at cost of equity. So let us look at this question. Management of an MNC TL Limited is engaged in construction of infrastructure project waste. Okay. A project to construct a toll road in Nepal is under consideration. Okay. The following information is available. Initial investment will be in the purchase of equipment costing 250 lakhs. See, the investment is USD 250 lakhs. The economic life of the equipment is 10 years. Depreciation of the equipment will be charged on SLM. Very simple. EBITDA to be collected from toll road is 33 lakh per annum for 20 years. So the toll is collected for 20 years, but the equipment will be depreciated, or the initial purchased equipment is depreciated only over 10 years. Okay. Then to encourage, and this is also given that also in USD only. To encourage investment, Nepalese government is offering a 15-year term loan of 150 lakhs at an interest rate of 6% per annum. The interest is to be paid annually. The loan will be repaid at the end of 15 years in one tranche. The required rate of return for the project under all equity financing is 12%. So cost of equity is 12. Post-tax cost of debt is 5.6. We wanted pre-tax cost. Let us see. Corporate tax rate is 30. Or we can simply find out 5.6 by 0.7 is 8. 8 is the pre-tax cost of debt. All cash flows will be in USD. Ignore inflation. Can anyone tell me, can you guys think why we are using pre-tax cost of debt? Always we use post-tax. Why are we using pre-tax? Arey Baba, you are computing the tax shield independently. That is why the debt is taken at a separate, debt is taken at a pre-tax rate, and the benefit of tax is computed separately and added as tax shield. That is why you take it at pre-tax cost of debt. Ignore inflation. Okay. You are required to advise the management on viability of the project using adjusted net present value method, or ANPV or APV. Present value at 12% for 10 years, then present value interest factor annuity 12% for 20 years, 8% for 15 years, then 8% for 15 years for the last annuity, and this one. How did they get 8%? Whatever I just did, 5.6. What is 5.6? The cost of debt post tax divided by 0.7, which is arriving at pre-tax 8%. That is why they gave 8%. See, cross match, immediately you can match. Now, supposed to value operating cash flow separately, tax shields separately, and subsidies separately. What are the subsidies here? The differential in interest rate is potential subsidy, and tax shield we'll find out. Now, first 1 to 20 years, you will get 33 lakhs USD per annum. So 33 lakhs at 12%, present value interest factor annuity for 20 years is, they have given the number here, is 7.469. So it will take 7.469. This is the inflow. Then you get subtract depreciation. Depreciation is how much? You have a 250 investment, divide by 10, so 25 per each year over only 10 years. So 25, and this 12% for 10 years also have they given? Yes, 5.65. That is 5.65. You take the present value. So you directly do everything at cumulative present value numbers only. Okay, 246 minus 141 gives you 105. Then you get tax. Tax is how much? 30%. You subtract tax, you get PAT. To the PAT, you add back the depreciation of 141. So you get CFAT of 215. 215 is the CFAT. And initial investment is 250. So you can put initial investment separately or combine it with the CFAT of operating cash flow. Either way, it doesn't matter. Either you can have 4 elements or 3 elements. So if you see this, APV is initial investment plus these 3. Okay, you can do these 2 together and those 2 separately also. So from operations, you get 214 minus 250, which is 35. To operations and initial cash outflow, after that, you have to add the present value of tax shield and present value of subsidies. Okay. Both of them you discount at what rate? At 8%, or you arrive at the present value at 8%. So loan for 15 years. What did they say? What is the loan for 15 years? To encourage Nepali government 15-year loan of USD 150 at an interest rate of 6%. Okay. So what loan USD, what is the interest every year? 6% on how much? 150 lakhs. 6% of 150 is 9. So 9 is the yearly interest. And what is the present value factor? You are going to discount the present value of tax shield and present value of subsidies. What is the tax shield? Tax shield is whatever is the interest that you are paying into the tax rate. What is the interest you are paying? 9 lakhs. 9 lakhs for how many years? For 15 years. What is the present value factor annuity for 15 years? At 8%, 8.55. So 9 into 8.55 is 77. Of that, 30% is your tax shield. So if you remember, I said I will explain to you what is tax shield when we come there. So this is the tax shield, is basically the NPV of the tax saving on the interest that is paid. That is known as tax shield. Okay. Then, so 23.013. Then you also have the subsidy. What is subsidy? If you take this 8% what we got, market rate is 8, but they are giving it to you at 6%. So there is a 2% benefit. There is a 2% benefit. So that 2% also you have to evaluate. So 2% on 150 lakhs, which basically works to 3 lakhs a year for 15 years. Present value interest factor is 8.55. 8.55 into this 3, which is per year value, you get 25. So you consider this minus 35, this is number 1. Then you consider plus 23, which is number 2. And you consider plus 25, which is number 3, you get 13.6952. So some of you may wonder, sir, we have already considered that at 6%, now why are we taking a additional 2%, even though we have not paid the loan or anything like that? Arey boss, what happens is this 2%, which is the subsidy that you have got, because of you getting that particular subsidy, it's a notional gain, because had you paid it at 8%, the project would not have been viable. So you have to compute it, you have to include it as the 2% gain what you are making. So what I did here, the differential between that 8% and 6% is 2%, which is this 3. For that I computed and added this. If you do all these 3, the NPV is 13.69. If you ignore, right, if you ignore this subsidy element, then the value is negative, which is minus 11.898. Okay, there are both ways. You can look at it another way completely. I will tell you another way how you can look at it. So you can look at it in another way. What is this another way? See, present value of operating cash flow. How much we have here? Got some number, no? Minus 25 or something. Minus 35 base NPV minus 35. Okay, this will keep minus 35 point, what was the number? 091. Okay, I'll keep it as it is. Then present value of debt including tax shield. See, what did we do earlier? We split the subsidy part separately and tax shield separately. Now I am saying combine everything and look at it. So, which is year 0, you have plus 150, that is you are getting an inflow of 150 in year 0. Year 1 to 15, okay, how long is the debt? Debt is a 15-year debt only, no? Yeah, 15 years. You are paying it at 6%. 6% of 150 is 9. So, you are paying 9. 1 to 15, you have tax impact of 30%, which is 30% of 9 is 2.7. So, this is plus, this is minus, and then this is plus, correct? Then you are also repaying. In 15th year, you are repaying 150, correct? So, these are the cash flows. So, for the first year, present value factor is 1. Year 1 to 15, cumulative present value factor at same 8%. Okay, at same 8% is 8.559, correct? That is what they gave. 8.559, and they gave 15th last year as 0.315. So, you take those. 8.559, 0.315, right? 315, yes, correct. 8.559, 0.315. So, now you multiply these and add all of them. 150 is equal to m plus minus 9 into 8.559 is equal to, then 2.7 into 8.559 is equal to, I do 23, I do m plus, then 150 into 0.315 is equal to 47, I do m minus. If I do memory recall, I get 8283. This is if I multiply the present values and add them up. This is purely the present value of financing of debt. This includes tax shield. This is tax plus subsidy, both. The reason why I am saying this, you will understand. So, present value of operating cash flows is minus 35. So, 48.823 minus 35.091, you will get it as 13.733. 7373. So, you got 13.733. Do you remember where we got a similar number? We got a similar number, 13.69, obviously adjusting for third and fourth decimal of present value factors. When you compute the three elements independently, operating cash flow, tax shield, subsidy, or tax shield plus subsidy together taken as value of debt financing. When you do this, you get the benefit. Now, some of you may wonder, sir, how did this suddenly benefit come out? Boss, you are discounting a 6% interest by 8%. That is why the debt has a positive value. 6% cash outflow, and on that you are adjusting even the tax, and then you are arriving at a present value factor using 8%. So, which is why your outflows become less, which is why you get a positive value for the debt, which can be split as your tax benefit separately or tax shield separately and your subsidy benefit or subsidy shield separately. Okay. So, this is one question I wanted to do, where you do the ANPV method or APV method. Now, after doing this, there are a couple of problems. I think we have solved all the major varieties of problems. There are, a couple of problems which I want to solve, which I want to solve, but if they come in exam, I don't want you to do it, because as it is, you have seen that these questions can be very confusing and twisted, right? I don't want you to waste time in the exam, as I explained earlier. So, we will go ahead and solve a couple of questions first. The first couple of questions, I think question number 1 and 2 of the P600 plus material, and then we will get back to the theory part. Okay, okay. Let us go and solve the first question, question number 1 and 2 now. Perfect Think, a US-based pharma company, has received an offer from AIDS Cure Limited, a company engaged in manufacturing of drugs to cure dengue, to set up manufacturing unit in Baddi, India, in joint venture. Okay, so foreign company investing in India. As per the JV agreement, Perfect Think will receive 55% of share of revenues. They will receive 55% of share of revenues plus a royalty at the rate of 1 cent per bottle. The initial investment will be 200 crores of machinery and factory, and scrap value of the machinery and factory is estimated at the end of 5 years to be 5 crores. 200 is the investment, 5 crores. Who is making this investment? We don't know. Let us see. The machinery is depreciable at 20% of the value net of salvage using SLM. Initial working capital to the tune of 50 crores shall be required, and thereafter 5 crores each year. So, if you look at this working capital thing, right? If you look at the working capital aspect, please remember one thing. Whenever there is working capital infusion, if the project is ending, at the end of the cycle, at the end of the project, the working capital comes back. Think of yourself as a Kirana store. You have initially put in some inventory for some level of sales. As the sales increases, your inventory level also increases. In the last year, when you have high sales, you will have maintained the high level of inventory. But at the end of the period, in the last year, when you are shutting it down, that inventory is left out. So that inventory, whatever you have, you again sell extra. Or another way to look at it is, in the last year, you don't buy additional inventory. Why? Because you know you're going to shut down the business, so you will not buy inventory. So your cash outflow with respect to last year for inventory will be lesser, which is why it is reduction in working capital. Okay. So here initial working capital of 50 crores shall be required, thereafter 5 crores every year, and at the end of the period that entire amount will come back. As per GOI directions, it is estimated the price per bottle will be rupees 750 and production will be rupees 24 crores bottles per year. The price in addition to inflation of respective years shall be increased by 1 rupee each. So inflation plus 1 rupee. The applicable tax rate in India is 30, 35 in US, and there is DTA. This is what I was saying, between India and US. According to agreement, tax credit shall be given in US for tax paid in India. So in US you have to pay only the differential tax. In both countries, taxes shall be paid in the following, in which profits have arisen or remittance received. This is another complication in this. As we move there, I'll explain what is the complication. Spot rate is 57 rupees per dollar. Inflation in India is 6%, expected to decrease every year by 0.5%, and 5% is the inflation in US. As per policy of the government, only 50% share can be remitted in the year in which they are realized, and the remaining in the following year. Although WACC of the company is 13% due to riskiness of the product, they're expecting a return of 15%. Determine whether they should invest in the project or not from subsidiary point of view. So from subsidiary point of view, that is when you are investing it there, you are getting cash flows, how are you going to evaluate it? And they want an NPV. Now if the company that you're going to evaluate is perfecting, the NPV should be in dollar terms. But a lot of the data is in rupee terms. So you have to first do everything in rupees and then convert to dollars. Okay. If you come back here, if you remember what we discussed, first identify projection currency. I said we need the projection currency, every projection has to be in rupee. Compute currency rates. Why? So that you have these conversion into dollar terms. Why? Because you have NPVs in dollar, and you compute currency rates using inflation rates or interest rate, whichever is given. Use currency for P&L projections where required. If it is required, we will use it. Ensure revenues and costs are nominal or real. So they have not given that nominal real. They have said that the price will increase by inflation and 1 rupee. So you have to take that into account. So if you come back and you first thing what you do, project the currency. So 57 is first year, then 1.06 is Indian rate, 1.05 is US rate. Then second year 1.055 by 1.05, so on and so forth. You project, you get this currency value. You get the value of the currency in which conversion has to be made. Why are we doing this first? Why are we not doing in the end? Because in between there may be some item which may require us to use this. What is that item? We'll see. Inflation India, inflation US, we know the numbers. Okay. Sales volume, they said 24 crore bottles every year. And what is the price? 7.5. But that is increased by 1 rupee every year, and there is also an inflation impact. So is it first 1 rupee add and then inflation, or is it first inflation add and then 1 rupee? This is again a unnecessary complication. They are not very clear about it, but you can take it this way. That is, you add 1 rupee, get the price, on that you take the inflation impact and you arrive at the revised price, sale price. Now what did they say? They are remitted, the 55% of revenues are remitted to them. So you have to find out revenue. What is revenue? Your 24 crore units multiplied by this, you get some revenue. That revenue you multiply by 55% to get your share of revenue that is remitted to you. In addition, you are also remitted some royalty. What is a royalty? Royalty is 1 cent. But 1 cent is, these are all in rupee terms, this is in dollar terms. So you please convert that 1 cent into rupee. That is why this 24 crores into 0.01, you get some value, multiply that with the exchange rate, which is why I said you need to compute the exchange rate first. So you get this is the royalty. Now what is the production cost? They themselves have given production cost ka some number. Production cost will be 40% of the revenue. So not only, see here what they said, they will receive 50% of share of revenue plus a royalty. If they are anyway going to directly receive share of revenue, do we need to subtract the production cost? So what they meant here is revenue minus the production cost, that is what they will receive. So that is an assumption you have to make. So royalty is given, then production cost at 40%. 40% of what? 40% of your share of revenue, not the entire revenue. Okay, your share of revenue, whatever is the production cost, you subtract it, and then you add, then you subtract depreciation. What is depreciation? Depreciation is, see, originally the investment is what? 200 crores. I'll clean this. Originally the investment is 200 crores. Depreciated over 5 years, SLM closing value is 5. So 200 minus 5 is 195. 195 by 5 is 39. So depreciation is 39 crores. So you subtract depreciation, you get PBT. Now the story doesn't end here. From PBT, you have to do a lot of other things. There is a tax issue and all of that. So first you put PBT, then you compute the tax in India. Tax in India is what? 30% of this PBT. Directly you will get some 11, 13 and on. So far so good. Then you make an assumption. Assumption saying what? See, there are two assumptions here. First assumption is, this company Perfect Inc. is in making the entire investment in the project, and the other company, Indian company, whatever AIDS Cure or whatever is that, they are doing only marketing. Why am I referring to this? Because investment, full investment is being made by Perfect Inc. That is what they said in the beginning. This is a set up a manufacturing unit, so on and so forth. Initial investment will be 200 crores. They never said the initial investment also will be shared in the ratio of 55-45. So investment is done by one fellow and the marketing is done by the other fellow. So you have to write that as an assumption. Second assumption what you have to make is, as far as US is concerned, you are going to remit the money. You have some PBT, there is a tax, then PAT. From PAT there is some, some portion of it is remitted. And they also said 50% remitted this year, 50% remitted next year. Now the question is, Indian tax is very clear on Indian profits, but US tax is on the profit or on the remittance. If it is on the remittance, then you get basically half remittance this year, then half remittance next year. On that, whatever you receive, half, on that only you pay tax, and that tax is also paid in the year after. Or is it on the actual profit? Okay, that clarity is not there. Again, this is why I don't like this, absolutely don't like this problem. So first compute the tax on India, tax in US. First let us do the simple way, that is, you tax is on profit, on PAT. Don't think of tax on cash flows. You get, and what is the extra tax? Difference between these two is extra tax, 1.89, so on and so forth, you get the extra tax. What is the PAT of the Indian company? You subtract Indian PBT minus Indian tax, you get the PAT in India. Then from PAT, how do you arrive at FCF? You add back depreciation, then you add back the tax that is actually paid, that is actually there in the P&L, and then you subtract the tax that is actually paid. So you are adding back the tax that is there in P&L, which is Indian tax. But Indian tax also they said is paid after 1 year. So you add back this initially and subtract it subsequently. Then you also have to make an adjustment for tax that is paid in US, that we'll see separately. First Indian tax adjustment is done here. Then its investment is 200 and the final scrap value is 5. So that entry is very simple. Working capital. As I said, working capital, first year 50, every year 555, so for 4 years. In the last year, you don't invest fresh working capital, but whatever you invested in the last 4 years comes back to you. So this entire 70 comes back to you. This is how you compute the net FCF from an Indian unit perspective. Now, what is it from an American perspective? The company which is receiving this FCF, whatever you have, you remit only half, especially with respect to the profits. So 71 ka half 35, 68 is 34, 74 is 37, 79 is 39. So you have 164. And last year, what is it? We will see. What is last year's tax? Whatever India tax you have paid in the last year, that is last year's cash outflow. So you have 71 ka half, 68 ka half, 37 ka half, 39, 70, 68 ka half, 74 ka half, 79 ka half, 164 ka half, and 20 whatever is there in last year is remitted in full. Now this is actual remittance of current year, then previous year remittance. You take then previous year remittance. After this, you compute the total remittance. Total remittance from a US perspective to US. But then US tax is also there. We will see that. This is INR. This INR you have to convert it into dollars. What are the dollar? We already have the dollars rate. You convert. You get some 43 million, 6, 12, 12, so on and so forth. To this, you subtract the USD tax. What is USD tax? We have already computed here, which is what? $1.89 that is paid in the next year. So that 1.89 you compute and arrive at tax that is to be paid in US in dollar terms, because 1.89 is rupee. You divide that by 57.82 and arrive at a dollar tax. So you finally arrive at a dollar tax that is to be paid. So you make this dollar tax adjustment to the cash flows numbers you have already arrived. Finally, you get cash flow of 43, 6, 11.8, so on and so forth. These are the cash flows. For that you do an NPV, and see, tax is on profits and not cash flows, hence working capital investment value are excluded in this. So you are computing this on the profit, not on the cash flow. So whatever this extra tax is there here, we computed somewhere, extra tax 3.47, same thing is what is considered here, okay, not on the entire cash flow value. Okay, so this is one assumption. There are two assumptions, as I said. One, everything they will bear and profits they will get, and marketing expenses are borne by the other party. Second assumption is profit taxation even in the US is on profits and not on remittance. So you take the present value factor at 15%, multiply this 43.86 with the present value factor, and arrive at an NPV of 0.58. It is positive. Now what is the second alternative? Second alternative, it is when the tax in US is on cash flow and not profit. So you have to come back 2-3 levels, which is you have arrived at this particular remittance. This remittance in INR terms. That INR terms you convert it into USD. So 43, 6.2, 12, 12, 12. So you take those number. 43, 6.24, 12, 12, all of that. That is the remittance from India. That is absolutely clear. Now tax in US is on what? Tax in US is on the actual remittance received. So what is the tax that you are paying? The 6.24 into 35%, which is 2.18. But this 2.18 is the tax that you are paying incremental, right? Whatever is the cash inflow, on that you have computed the tax, but you should not pay the entire tax, you should pay only the incremental tax. What is the tax you have already paid? Whatever you have paid in India here. What is the tax that you have paid in India here? This one. So this 11.33 you have to again convert it into dollar terms. So 11.33 when you convert it into dollar, you get 1.96. So 1.96 you've already paid, 2.18 you have to pay. The net difference is what? You have to pay extra in US. So extra in US you pay 0.22, 1.87, 1.51, 1.42 and 3.8. You add all of this, you basically get the final net cash flow. Net CFAT, post-tax CFAT. Here tax is on profits in India and it is on cash flows in US. That you multiply with the present value factor. You get some cash flow values. That cash flow values you take an NPV, you get 4.16. Now if you see here, how have we arrived at it? See, initially we thought there are only 6 years. But as far as US is concerned, the remittance happens, half of the remittance happens the next year. And the tax is paid in the year after the remittance. So 5th year, whatever is the profit in India, half of it is paid in 5th year to US and half is paid in 6th year. Whatever is paid in 6th year to US, to that tax is there in 7th year in US. So you have to compute even 7th year's cash flow and then arrive at a NPV. So please remember this 7th year cash flow also has to be computed. So this is a very tricky, painful, long problem, which is what I would strongly suggest not to do in the exam, because the scope for too many assumptions, scope for too many mistakes. Now let us look at the next question. It's Entertainment Limited, an Indian amusement company, is happy with the success of its water park in India. The company wants to repeat its success in Nepal, establishing a grand water park with world-class amenities, and is also encouraged by a marketing research report which it has prepared for rupees 20 lakhs. What is the relevance of this 20 lakhs marketing research report? Sunk cost. Don't bother. Estimated cost of construction would be Nepali rupee 450 crores and it will be completed in 1 year's time. It will take 1 year to complete. Half the construction cost will be paid in the beginning and rest at the end of the year. Okay, construction cost half in year 0, half at period 0, half at end of year 1. So you can take it as year 1. In addition, working capital requirement will be 65 crores from the year end 1. From year end 1, it is 65 crores. Okay, please remember that. That is in the year 2 onwards, it is 65. The after-tax realizable value of fixed asset after 4 years of operation is 250 crore. So, and again, it is a Nepali rupee only. Under the foreign capital encouragement policy of Nepal, companies allow 20% depreciation on reducing balance, that is WDB, for maximum capital limit of 200 crores. So, here are they referring to this 200 crores as the overall depreciation or overall value of the fixed assets? We will see. The company can raise loan for theme park at 9% in Nepal. The water park will have a maximum capacity of 20,000 visitors per day on an average and is expected to have 70% capacity of the first 4 years. The entry ticket is expected NPR 220 per person, and in addition to entry ticket revenue, the company could earn revenue from sale of food and beverages and fancy items. The average sale price is 150 per visitor for food and beverages and 50 per visitor for fancy items. The sale margin on food and beverages and fancy items is 20% and 50% respectively, and the park would be open for 360 days a year. The annual staffing cost would be 65 crores per year and annual insurance would be 5 crores per year. Other running and maintenance costs are expected to be 25 crores in the first year of operation. They said this 25 crores, the other maintenance cost of 25 crores is first year of operation, which is expected to increase rupees 4 crores every year. Company would apportion existing overheads to the tune of 5 crores to park. Existing overheads, do you consider them in evaluation of the project? No. All costs and receipts mentioned excluding construction cost, asset realizable value and other running and maintenance are at current prices, which are expected to increase by 5% per year. So all these items are on day 0. How long is park operating, or how long is the construction activity? Full year 1. From year 1 it is valid for 4 years. So from year 2 onwards this cost will be there. But the values are given for period 0. So you have to compute period 1 and period 2. This is a very important aspect in this particular question. The current spot rate is 1.6 NPR per rupee. The tax rate in India is 30 and Nepal it is 20. The average market return is 11% and interest rate on treasury bond is 8%. Current equity beta is 0.45 and current funding ratio for park would be 55 equity, 45 debt. Being a tourist place, the amusement industry in Nepal is competitive and very different from Indian counterpart. The company has gathered relevant information about its competitor in Nepal. The competitor market value of equity is 1850 CR and debt is 510 CR and equity beta is 1.35. State whether its entertainment limited should undertake water park project in Nepal or not. Don't take up I don't know whether they should take up the project or not, but don't solve this problem in the exam. That is my suggestion. Unless of course there is no other way out. So what do we do first? First, we have to figure out that currency rate. Is there a depreciation, appreciation currency? No, they have not given. So that is out of the question. Then, in which currency are the projections to be made? Everything is given in NPR, so you have to make an NPR. Right. But what about the conversion to Indian rupee? We will see that. Right. So first, year 1 to 5, 0 to 5, because of depreciation, how do you compute? And depreciation, we said only 200 crores is the maximum capital value. So we take 200 crores as the value on which depreciation is allowed. So of that 20%. So every year 20, 20, 20 on WDV basis, you will get the actual depreciation every year. Then you come to P&L. Why did they say how many visitors? They said 20,000 visitors is the capacity per day, of which 70% is utilization and 360 days is the operation. So you multiply this, you get some 50,40,000 visitors in a year. What is the ticket price? 220. 220 in when? Year 0. What is the growth rate? 5% per annum. So, but in the first year of operation, ticket price is already gone up twice. Okay. So, this is a very, very important thing that you should remember. Right. But when you come to F&B and fancy items, you need not compute the sales and cost and all that. Directly take the margin. Why? Because there is no value add to doing that. Right. So, what is the margin here? If you look at it, average sales price of fancy items, of food and beverage is 150 and margin is 20%. So, 20% of 150 is 30 and 50 is the price for gift items. So, of which 50% is margin. So, 25. 30 plus 25 is 55. So, 30 and 25. Okay. They also are given for year 0. So, you inflate them also at 5% every year and arrive at these numbers. If you add the sales and margin, you will get basically the revenue per user. Revenue per user. Please don't get confused that this is the revenue per year. This is the revenue per user per year. How many users are there? Visitors are there? 50,40,000. So, you multiply it with 50,40,000 to arrive at revenue in crores. In NPR crores. So, 152, 160, 168, 176 is the revenue in crores. From that you subtract the other cost. And they said, what is the other cost? Staffing cost will be 65 crores, insurance cost will be 5 crores. Both of them they said year 0 only. Other running and maintenance are expected to be 25 in the first year of operation. Operation is when not 0, not 1 but 2. Right. So, 65 and 5. You have 65 and 5. So, for that also you have inflation. So, you make the inflation adjustment and project these numbers. But the maintenance is 25 in the first year. Depreciation also, the maintenance 25, it is first year of operation, which is actually year 2 of the project. So, depreciation, we anyway have the number. So, arrive, then you subtract from this revenue plus margin minus all these cost minus depreciation, you arrive at PBT. On this PBT, tax rate. Tax rate is what? 20% in Nepal. So, minus 20%, you get the PAT. This PAT is not FCF. What are the changes in this PAT that you have to do? One, of course, you have to add back depreciation. So, you add back the depreciation. And you also have working capital and capex related items. What is working capital? They said working capital is 65 crores at the end of year 1. And they also said all costs and receipts excluding construction costs, assessed reliable and other maintenance expenses mentioned above at current price and expect to increase by 5% every year. So working capital also you have to assume as increasing by 5% every year. Why? Because everything is increasing by 5%. So 65 and every year 5. In the last year, and so only the incremental 5 is the working capital outflow in year 2. Okay, so that is the case, but in the last year you get back everything that you have invested. So if you take 65 plus 3.25 plus 3.41 plus 3.58, how did I get 3.25? 65 into 5% is 3.25 plus 65 is equal to 68.25 into 5% is 3.4125, which is what this is. Okay, and you have obviously they have said, you know, on day 0 you invest 225, at the end of the year 1 you invest 225. And do you get any money back? Did they say anything about money getting back? After tax 4 years is expected to be 250 CR. So after you do this entire thing, you get back 250 crores. You get back 250 crores. So you add all of these. You add what all items? You add 225, 225 is very simple. But then here when it comes to FCF, 8.5 plus 40 minus 3. 48 minus 3, 45. For last year it is 224 plus 20, 44 plus 75. 44 plus 75 is 120. 120 plus 250 is 370. That is what you get. 369. I am doing rough numbers. When you do using calculator, you get the exact number. So you get back the invested, you get back the scrap value or whatever is the realizable value as well as the invested working capital. Now till here it is okay. Now how do you discount this? At what rate do you discount? So for you to discount, you have to figure out what is the WACC. For you to figure out the WACC, you have the ratios of debt equity 55-45, but you don't know the cost of equity. For cost of equity, you need to find out the beta. You know the risk-free rate of 9%, but what is the beta? You know that risk-free rate is of treasury bond is 8% and average market return is 11%. So you have to compute the beta. How do you compute beta? You take the competitor. Competitor has 1850 and 510 as its equity debt and beta of 1.35. So the ratio is 78:22. Now beta what they have given is what? Levered beta. So you have to arrive at unlevered beta. So equity beta, which is 1.35 into 0.78 divided by 0.78 plus 0.22 to 1 minus tax rate of 20%. This is what is the tax rate in Nepal, right? So 0.22 into 0.8 is equal to 0.176 plus 0.78 is equal to 0.956. I'll do m plus 0.78 divided by, memory recall, 0.956 is 0.81 into 1.35. You get 1.101. So you can take 1.11. Okay. So asset beta of the competitor or unlevered beta of the competitor is 1.11. That you have to again relever for your debt equity, which is 55-45. You can take actual equity values or you can take 55:45. So 1.11 is the asset beta. 1.11 asset beta will remain the same for you also. At 1.11 asset beta, which is the unlevered beta, you have to find out the levered equity beta. So 1.11 is equal to equity beta into equity by equity plus debt into 1 minus tax. So debt is what? 45%. 0.45 into 0.8 makes it 0.32 plus 0.55. This is the denominator of 0.87. So if you are wondering what am I doing, I am doing this part. This is the denominator. Numerator is what? 0.55. 0.55 divided by 0.87 is 0.63. 0.63 into equity beta is equal to 1.11. 0.63 into equity is equal to 1.11. So 1.11 by 0.63. So 0.11 into you multiply this ratio, you get equity beta of 1.84, approximately 1.84. So now using this 1.84, you have to figure out what is the cost of equity. How do you figure out cost of equity? RF plus beta into MRP. So what is MRP? Your 11% minus RF of 8%. So 8% plus 1.84 into 3, you get 13.51. So all this activity we did to find out the cost of equity. Then cost of debt is 9%. You compute the weighted average, you get 10.67. This is post-tax weighted average, 10.67. This 10.67, whatever WACC you got, you do this, apply that particular present value factor to the free cash flow. So 225, 290, all of these you apply at 10.67%. You get these present value factors, you multiply that, you get an NPV of 167.5, which is negative. So So the company, its entertainment should not invest in this project as NPV is negative at this level. Now you see this kind of question, you have spent so much time, energy, assumptions, confusion, multiplication, complication, computation, calculator, everything. And when I am solving it without using calculator, where because I already have a solution, it is taking me so much time. If you are going to solve this in exam, please budget 1 hour of time and you will make a lot of mistakes. So my suggestion, unless you don't have any other option, don't solve these kind of questions. IFM as a topic, there are GDR questions which you can solve. There are simpler questions you can solve. Moment they give a complex problem, don't solve. Okay. If possible. If not possible, then obviously there is no other way out. But if possible, don't solve. Okay. Now we have looked at all the problem side. Now let us come and finish the theory aspects. If you remember the theoretical aspects, we ended at what are the various ways of debt routes. Then we said there is something called as International Financial Center. What is it? What do they do? And all of that. Let us go and start with IFC. IFC, International Financial Center, is a financial center that caters to the needs of customers outside their own jurisdiction, that is in Gandhinagar in Gujarat, they have set up a international financial center in IFSC. In that particular place, as far as law is concerned, not your traffic rules and all that, as far as laws with respect to the financial transactions are concerned, even though that particular location is in India, laws of India won't apply. Okay, so it is outside the jurisdiction of our own country as far as that particular location is concerned. So what happens? All foreigners can come and invest there and operate it as if it is their own country there, as far as purely from an operating perspective, not the land ownership. Okay, how is the land ownership done? All that is different. But as far as the regulations and rules are concerned, they are international laws. So it is a hub that deals with flow of funds, financial products and financial services, even though its own land and country, but with a different set of regulations and laws. So there is a different set. Provides flexibility in currency trading, insurance, banking and other financial services. So what all fancy, weird financial instruments are there outside India, which we cannot trade in India, we can trade in IFSC in Gandhinagar, near Gandhinagar in Gujarat. This flexible regime attracts foreign investors, benefiting not only the stakeholders but also country hosting IFC itself. So, Dubai has it. There are quite a few countries which have developed something, and this enables faster growth. So, what are the benefits of this IFSC? Opportunity for qualified foreign professionals to come into India. Foreign people can come and stay. Platform for qualified and talented young professionals, Indian professionals, to pursue global opportunities. So, we can, within India itself, we can pursue international jobs with such kind of salaries. Stops brain drain from India, obviously. Bring into India financial service transactions carried out by overseas financial institutions or entities or their branches or subsidiaries. So, whatever transactions are done outside India, bring them within to the shores of India, but in an IFSC. Trading of complicated financial derivatives can be done from India. You can do this from India. So, what are the constituents? Basically, what are the elements? Highly developed infrastructure, both physical and technological infrastructure. Stable political environment. Strategic location, located in good airport, sea coast, and all that. Good quality life. Rational regulatory framework. Not the domestic laws won't apply, international laws will apply. Sustainable economy. So basically, it is a place where everything comes together to make it a wonderful place for foreigners to come and invest. Now, GIFT IFSC. What is GIFT IFSC? Gujarat International Financial Services. Gujarat International Financial Trade Center. That is what it is. India set up IFSC Gandhinagar to compete with its rival IFSC in Dubai and Hong Kong. Main motive, retain the financial service business India from moving out. Agreed. GIFT City provides foreign investors separate jurisdiction to do business with relaxed tax and other laws. So you have different laws applying there. Government operationalized IFSC at GIFT multi-service SEC in April 15. The union budget provided competitive tax regime for IFSC at GIFT SEC. India's first international exchange, India INX, a wholly owned subsidiary of BSE, inaugurated on 9th Jan 17, and INX has started trading in index, currency, commodity and equity derivatives. So, we have also set up an exchange there, which is doing all of this. On 5th June 17, NSE also launched its trading at GIFT in equity, currency, interest rate and futures in commodities. So, NSE also started. GIFT IFSC provides very competitive cost of operations with very competitive tax regime, single window clearance, relaxed company law provisions, international arbitration center with overall facilitation of doing business. It is now moving fast towards unified regulatory mechanism. So, it has a completely separate set of laws with very focus on ease of doing business. It is a new financial technology gateway for India to the world. FEMA is not applicable, so international laws will apply. New financial institutions that are setting up business units in GIFT, as they will pay reduced taxes as valid for ACCA and can easily offer foreign currency loans to Indian companies abroad and foreign firms. So they will act as if they are abroad and offer loans. Then you have something called a sovereign wealth fund. What is a sovereign wealth fund? And please note on this GIFT IFSC was a question very, very important, and I believe this even the sovereign wealth fund is a very important question in the upcoming attempts. What is a sovereign wealth fund? It's a state-owned investment fund comprising of money generated by government, basically surplus money of the government. Money is derived from government from country's own surplus. That is what I was saying. It provides a benefit to country's economy and its citizens. How does it provide a benefit? Because you create a fund using which you invest in other countries. The legal basis on which these are created varies from government to government. Legal basis for sovereign wealth fund can be constitutive law, fiscal law, constitution, company law, or any other regulation. So you create a company or you create an entity or something which is basically a fund which will go and invest outside, or it may invest inside also, but largely it will invest outside. What are the objectives of SWF? Protection and stabilization of economy from export or revenue volatility. So the goal is to protect the country. Diversify from non-renewable commodity exports. So if you have a lot of exports, you diversify, you probably go and build businesses elsewhere. Earn better returns than returns on forex reserves. So you probably, when you invest outside, you may invest in companies also and you earn better returns. Assist monetary authorities dissipate unwanted liquidity. So if there's too much of liquidity in the country, there is a problem. So they will move away all the liquidity to some other country. Increase the saving for future generations, fund social and economic development. So Singapore, Malaysia, Middle East, quite a few countries, they have sovereign wealth funds. Those are used for helping their own population. That is, they invest in Indian startups, and whatever returns they get, that they take back to their country, and it helps their citizens. And ensures sustainable long-term capital growth. Obviously, it ensures growth. Then there is it's also political strategy. China uses this a lot to ensure that they meet their political objectives. So they go and make investments in Africa, buy out mines somewhere, they do all of that stuff. What are the sources? Natural resources or revenue or trade surplus, banking resources from budgeting excesses, foreign currency operations, monetization, privatization, or governmental transfer payments. So basically any kind of surplus that the government generates, they use this. What are the classification of SWF, or types basically? Stabilization fund, savings or future generation fund, public benefit pension reserve fund, reserve investment funds, and strategic development sovereign wealth funds. So basically you have multiple types of funds which they can be classified in different forms. And then we also have types of SWF: sovereign wealth fund, public pension fund, state-owned enterprises, or sovereign wealth enterprises. So you can also, the form also is different. Then complexities in international financial management. This is a very, this is a slightly boring topic is what people perceive, but there is a potential for question here. I will tell you what. When you manage finances, or when a company has operations across multiple regions, countries, and all of that, managing that money becomes a challenge. So what are these complexities? You see, wider financing options, local plus global. That is, if you have money across, located across multiple subsidiaries of yours across the world, you have multiple financing options. So you can take current local loans, foreign loans or bonds, multiple types. We saw multiple types of loans, right? Variation of interest and tax rate among different countries. So moving money is not a joke. There are multiple tax complications and interest rate complications. You have to be very, very careful. Foreign exchange risk. If you have money in a country where the exchange rate is going to depreciate, gone. So you have to be very careful. Blockage of funds. Some countries don't allow money to move out. Rules and regulations of transfer pricing. Just because you have subsidiaries doesn't mean you can price at whichever price you want. We discussed transfer pricing. You have in income tax also, where they explain how, at what rate you will consider transfer pricing and how will you compute tax. So these are all complexities that arise when you are supposed to manage money across various jurisdictions. What is international working capital management? You have multinational cash management, international inventory management, and receivables. All three, cash, inventory, and receivables, all three become very difficult. Let us see. What is the objectives of multinational cash management? Cash is the more important thing. That's what we're going to discuss more. Effectively managing and controlling cash resources of the company. That is one of the goals. You have to manage money carefully. Improving cash collections and disbursements. You have to ensure that money comes faster and you pay on time. Accurately forecasting cash flow patterns. So that becomes a very important thing. When you have money coming from multiple locations to multiple locations, ability to forecast properly is very important. Achieving optimal utilization and conservation of funds. Just because you're getting from multiple resources, you can't say that, I will let it lie idle. You have to effectively use it. Making money available as and when needed. Not only you have to use it, you should also have it available when you have to make payments, minimizing the cash balance. That is what I was saying. Then increasing the risk adjusted return on the fund that is to be invested. So when you get the money, you should ensure that you get very good risk adjusted return. What are objectives of effective system of international cash management? You minimize, this is the objectives of effective system. Here what are the objectives of multinational cash management? Both are slightly different, be very clear. You have to minimize currency risk, minimize overall cash requirements without disturbing subsidiary operations, minimize transaction costs, minimize country's political risk, and take advantages of economies of scale as well as reap benefits. Now if you see, these are conflictive objectives, which is minimize transaction costs and minimize political risk. How will you minimize political risk? By moving money out of a country which has political risk. If you keep moving money out, you will have higher transaction costs. So these two are conflicting objectives. So you need to figure out constantly what is the thing or what, which one is important today. Is managing political risk is important or minimizing transaction cost important? You have to do a cost weighted cost benefit analysis. So how does this centralized cash management help? It leads to centralization of information. If all information is there in one set of people. Reports and decision making process is also centralized, so they know very clearly what is happening, and movement and investment. So it enables you to move money and invest money according to what your objectives are. All these three are centralized. Then benefits of this centralized cash management system: maintaining minimum cash balance. Because you know the position across all locations, you maintain minimum balance everywhere and don't unnecessarily let funds lie idle at one place. You manage with liquidity requirements, move money from here to there to manage liquidity. Minimize foreign exchange exposure. If you know that there is one location where there are both inflows and outflows, you ensure that both of them match there itself. You don't move everything to another geography. Then generate maximum returns by investing all cash resources optimally. So you generate maximum returns. Netting to reduce transaction costs and currency exposure. Netting, that is what I was explaining you. Use transfer pricing to increase profit. Sometimes you do transfer pricing, and exploit currency movement correlation. So if there are currency movement correlations, you try and play on that and generate money. Right, this is the benefit of a centralized cash system. Now, how do you optimize cash flows in a multinational setting? See, there are so many things respected to cash flow management only. There are various routes. One is called accelerating the cash flows, managing blocked funds, leading and lagging, transfer pricing, netting, and investing excess cash. So we are going to learn about all of these, and in depth we are going to learn about this netting, because there's a problem on that. What is this accelerating cash flows? Faster cash recovery helps firms to use in working capital, invest and earn more. So you try and get cash as fast as possible so that you reduce your working capital. Managing blocked funds. If there is, we discussed about blocked funds. Certain countries say you have to invest money here only, any profit you can't take out, you have to invest. So reinvest locally to create jobs and reduce unemployment. Local banks loan repaid by blocked funds. So you borrow money from local banks and then repay it using the blocked funds. Analyze potential future funds blockage and attached political risk. So if the blocked funds are there and there is a political risk attached, try and figure out a way to get that blocked funds out. What is a political risk? Basically some kind of, the country dictator comes in. Like some South American country or African country, dictator comes in, it doesn't allow you to take your money out, or there is that currency depreciates sharply. So you have, those are political risks. Then you have leading and lagging. Adjust timing of cash flow with money movements, reduce forex exposure and increase working capital. So this is again conflicting objective. You want to reduce forex exposure by maintaining high level of debtors and high receivables and high payables, so that they both net off each other. But then if you have high level of money blocked there, there's a cost, but then that also reduces your forex risk. So it is a balance. Accelerate or delay the timing of forex payment by adjusting credit terms. So try and adjust the credit terms to ensure that you do this matching of cash flows. Pay your suppliers faster or collect from your customers faster and match both. Importer applies leading strategy if home currency is depreciating. So leading is basically collect faster. That is, if your home currency, if I am an importer, right? If I am if I am in India, if my currency rupee, it is on some rate, so let's say it is at some 85. 85 is depreciating to 90. What will I want to do? If I have to make foreign currency payments, what will I do? I will pay quickly. So I will collect my money fast and I will pay off quickly. Let us say I am exporter, I am say Infosys in India, and my currency is depreciating. What will I say? I will say, US company, please pay me late, because why I will get better value in terms of rupees when my currency is depreciating against the dollar. So exporter applies lagging strategy if home company currency is depreciating. This you have to remember. Then you have transfer pricing. Higher transfer price implies higher profits for transferor division. If I am transferring something to you, and let's say you are in a very dangerous country where there are a lot of risks, so I will say I will transfer at a very high price. You are a subsidiary in US and there is some problem in US. I am selling the product to you. I will say my product cost is 100, but I will charge you 300. So you will have to give me 300 rupees. What has happened by this? I have sucked away money from you. So I charge a higher transfer price. Then transfer pricing also subject to exchange restrictions. So you can't randomly do transfer pricing. There are some foreign exchange restrictions. Also to consider inflation differentials, import duties, tax differentials, quotas imposed by host country. So you have to consider all of these before you do any of these transfer pricing issues. Then you have netting. We will discuss about netting. There are two types, bilateral and multilateral. It is used to reduce administrative and transaction costs on currency conversion. Okay, when you convert into currency, you try and net so that you don't lose money on currency conversion. Payables and receivables are offset, reduces number of transactions and minimize total intercompany fund flow. If you have any excess cash, pool excess funds from all subsidiaries, earn higher returns on larger deposits, and that is euro currency market, euro dollar deposits. So if you have excess funds, pool all of those in a place where you can earn better returns. Convert excess funds into single currency after undertaking cost benefit. So don't keep excess funds everywhere, keep nominal. If it's one currency or one country is giving you better return, convert that. Diversify portfolio to different currency and avoid. So you are saying two things. One, you say pool everything. Other time you are saying diversify, because if there are risks, you have to diversify. So you have to do a cost benefit analysis of whether you should diversify or whether you should pool. So it's a very dangerous thing. It's not an easy thing. Now let us look at this. What are this netting system, bilateral and multilateral? What is bilateral? Involves transaction between parent and subsidiary between two subsidiaries, that is only two people. A purchases 10 million of goods from B and B purchases 15 million goods of A from A. In bilateral setting, B pays to A only 5 million. That is, I adjust for whatever is payable and receivable and pay or receive only the balance. What is multilateral? Payment arrangement among multiple parties. Transactions are summed and settled individually. Netting is centralized in one area. This calls for consolidation of information, net cash flow position for each pair of subsidiaries. So if you see, there is an example. India, US, UK, Italy. Okay, they have to pay. India has to pay USA 40, 30 to UK, 80 to Italy. India has to pay 150 total payments. USA has to make 100 to India, 20 to UK, 40 to Italy, 160 overall. Like that, all parties payments and receipts details are there. What is the total value? Total value is 710. So you see, India has to receive 250, pay 150, so it has net receiving of 100. Like that, you do for every country. You see what is net payment, what net receipts, and all the net paying countries will pay to the net receiving country. That way you adjust off. This is one good question or likely question sometime if they want to ask. Okay. Without netting, total payments are 710. Through multilateral, these transactions can be reduced to 100 million. Correct. Right. This is how you avoid too much of money movement. Now we have discussed about cash. Now we are coming to inventory. International inventory management, how does it happen? MNC firms source inventory from global affiliates. Obviously, they have multiple places from which they source. Normally possess higher than EOQ stocks, known as stockpiling. So even because they source from multiple places, they always maintain more than EOQ stock. That is not just the economic order quantity, they maintain more than that. It's called stockpiling because they have risks that they face when stock comes from international jurisdictions. Helps avoid political uncertainties, bottlenecks on imports and forex risks. It ensures all these risks are met. If the probability of interruption is very high, stockpiling, even if not justified on account of higher cost. So even if the cost is more, if the risk is high, you do stockpiling. MNCs must consider risk and reward of maintaining higher inventory, especially in international supply chain management. This is a very important thing. Then you look at international receivables. How do you manage receivables? Interfirm, intrafirm. Interfirm means between firms. Exporter wants to invoice in a strong currency, obviously. So if I am in India, I will want to always invoice in dollars. Why? So that when I get money, I get it in rupees, and rupee keeps depreciating, so I get more rupees. May invoice in a week if it has debt. So Infosys may want to invoice in rupees if it has a rupee debt, or Infosys may want to, let's say, invoice in euro to a US customer. Why? It has a euro loan. So the euro loan and euro receipts from a US customer both will knock off. Importer wants an invoice in weak currency. So importer. If I am an Indian importer, RAL, I will say, boss, please don't invoice me in dollars. Dollar is constantly appreciating, rupee is depreciating, so please invoice me in rupee. applies leading and lagging strategies. Both in we discussed leading and lagging. We will try those strategies to ensure that you net off the currency exposure. Considers political, forex, interest rate, and competition risk. So you have to consider all of these when you manage your receivables, international receivables. Intra-firm. What is intra-firm? Focus on global allocation of firms' resources. So it is not between firms, it is within the firm. So you are more bothered about allocating across multiple places. So production assembly is across various geographies, but is still within the same firm. It may lead to high receivables. Obviously it leads to high receivables because you are not bothered because it's all within the firm, right? Whether the receivable is just notional. You may have additional problems because of this, because some entity may not have cash. That's a different problem. But receivables and payables are not much of an issue because all within the firm. Delays do not affect the firm as money is within the firm. There may be a problem with respect to a unit not having money, but overall money is there within the company. Right. So these are the issues when you look at international trade receivables. So this concludes this chapter. It's a slightly, as I said, as I continuously keep repeating, if you get tough questions from this chapter, don't solve it because it will consume away too much time. Okay, fair enough. Now, please do like, share, subscribe to our channel, watch this video. There are many more such videos. If you're watching on YouTube, great. There is a playlist of these revision videos of all chapters. If you're watching this on Fast Track course on our website, great. Please go and watch the next chapter. Okay, chalo, all the very best and succeed in your upcoming exams.